Investor Advisory Committee meeting. Before we get started with our two afternoon panels, I want to recognize that Nancy Lamont joined us this morning, and also member Lori Lucas has joined us. So we're going to continue with best execution discussion on the first panel this afternoon, and then move to the 10B51 panel. I want to thank JW and Mina for their efforts in putting together this first panel this afternoon. With that, I'll turn it back to you, JW.
Thank you, Jennifer, and I want to thank all of our panelists. I want to thank Adam and Sinich for helping us put this together, and Rick from the Investor Advocate's Office. I want to thank Mina for all her help. Every time I was in a crisis, Mina solved it in helping to put this together. So thank you all so much for that. And I will miss you terribly as a colleague, Mina, but we're going to get you back as a panelist in some way. So you think you get out, but we'll always pull you back in. I want to introduce all of our panelists today. We start by introducing Stanislav Dolgopolov. He works at Decimus Capital Markets. He's taught securities regulation at UCLA. Has co-authored a book with Chaim Bodik titled The Market Structure Crisis, Electronic Markets, High-Frequency Trading, and Dark Pools. And on a personal note, Henry Manny, the founder of my law school, once told me that he was a mentor to me, and he told me, I think ominously, that his most important mentee ever was Stan. So I took that as a hit and a good word for Stan. Larry Tabb, welcome, Larry. Larry's been in these discussions and is omnipresent in discussions about market structure. Larry serves as the Director of Market Structure Research at Bloomberg now, and previously was chair of the Tabb Group, where he was a convener for various panels and events about market structure and a frequent speaker on these topics. Welcome, Larry. We're glad to have your help in these issues. We welcome Hitesh Mittal, the founder and CEO of Best Execution Research and the former global head of trading at AQR. Hitesh, just like Stan, has a recent paper out about these issues, and so we look forward to discussing those papers and everyone else's materials. I think there were some 200-300 pages of materials sent. So we've got a lot to digest here, and our panelists will help us do it. Although even after the panels, I recommend folks go in and read everyone's submissions. Doug, Larry, Hitesh, and Stan, and our first panel. I want to welcome Doug Sifu, who is the CEO of Virtue Financial. He's a former partner at Paul Weiss, and Virtue Financial is often colloquially described as a wholesaler or an internalizer. So they will have the on-the-grounds experience to help us understand some of these issues. So we welcome all of you. We will have some 10 to 12 minutes of discussion here of opening statements, opening remarks, and then we'll move to a discussion where we'll take questions first from the chair and commissioners, and then from the members of the IAC. IAC members, please let me know in the chat as you jump into the queue, and no reason to wait. Jump into the queue as soon as you can, so we'll have a full queue when we go to questions. All right, Stan, welcome, and the floor is yours.
Oh, well, thank you so much. It's a tremendous honor to be here. I'm even wearing a suit and a tie and even matching pants for the first time in like 16 months. I'm the Chief Regulatory Officer for Decimus Capital Markets, which is a regulatory consulting firm. And I've written extensively on market structure issues, including 2 long law review articles about the best execution obligations of off-exchange market makers and wholesalers. So it's a very relevant topic, of course, for this panel. So let me start off. Second slide, please. So I just want to set the stage for our discussion here. I'm not a data guy. Larry's a data guy, Hitesh is a data guy, and Doug is both a lawyer and a data guy. But I really want to focus on legal and regulatory issues. So, and the first point I'm trying to make here is that the business model of wholesaling, I have those elements listed here. It's been extremely stable over the last 30 years or so, despite technological and regulatory changes. And not necessarily every single element is present. For instance, PFOF is not synonymous with wholesaling. I have this great quote by Bernie Madoff. And by the way, his market making business was a legitimate one. and it should not be confused with the hedge fund fraud. So, and of course, the division of labor between customer-facing brokers and wholesalers makes a lot of sense. It goes back to the notion of the division of labor by Adam Smith, and probably we don't want to see any vertical integration like Vertibuy and Robinhood or vice versa. And here's a critical point. There is no direct, typically there is no direct customer-broker relationship between wholesalers and ultimate customers, such as retail traders. But the duty of best execution could apply to multiple parties in the execution chain. And legally, there are three reasons why it's so. First of all, a wholesaler could voluntarily assume the duty of best execution. Secondly, there could be broad agency/executing broker relationship, which is pretty much typical. And finally, there is a very sophisticated regulatory framework developed by FINRA. Second slide, please. It's very fashionable to criticize FINRA, but I'm just going to say that it has created a very sophisticated framework. And the reason behind that is that back in 2006, NASD was very much concerned about captive order flow relationships where wholesalers had disclaimed the duty of best execution entirely. And of course, it was a horrible arrangement, a captive order flow relationship with no guarantee of best execution. And there's more historical information here, but going back to what FINRA has right now, FINRA has stated very explicitly that the duty of best execution could apply to different parties in the execution chain, but those obligations are not necessarily identical. And I have a key example here: a customer-facing broker could get away with periodic review, but a wholesaler needs to review each order individually if it's internalized. Next slide, please. In a quick comparison of the regulatory regime in Europe, both similarities and differences are kind of striking. For instance, in Europe, wholesalers they actually have quoting obligations. It's not true. It's not true here in the United States, even though wholesalers could be DMMs as well. And here's another key distinction. In Europe, the tick size regime applies to wholesalers, systematic internalizers. It applies to price improvement and quoting and executions, of course. Next slide, please. And I'm going to talk very briefly and very quickly about weak spots for best execution and wholesaling. There have been several enforcement actions, and like recently. I'm not going to claim that there is a general practices, but we have very prominent illustrations here, and we could be talking about data feed arbitrage, odd lot arbitrage, insertion of delays, trading ahead. And another critical point here is that there are overlapping regulations. For instance, a wholesaler, in addition to the duty of best execution, is also subject to the trade-through rule, Rule 611, as a market center. But it's critical to point out that complying with the other regulations and norms does not necessarily create a safe harbor for best execution. And a quick note about zero commission trades. Forget about gamification for a second, but in some respect, that phenomenon has been distortionary, and we have seen customer-facing brokers even disclaiming the duty of best execution, which is not disclaimable. Next slide, please. More weak spots for best execution rerouting practices. We could be talking about affiliated dark pools, rerouting large orders in terms of routing techniques, use of ISOs, market sweep orders, and one illustration is the IAC is dealing with order type controversy. Price improvement practices, because wholesalers often engage in back-to-back transactions, that price improvement needs to be passed on to the ultimate customer. Odd lot is a pretty significant issue, and some insiders have explicitly said that wholesalers could benefit from discrepancy from round lot and odd lot prices, which is a problem. Next slide, please. Okay, front running, narrative front running, it does not make much sense, but there has been another theory that wholesalers might be front running stop loss orders. I'm somewhat skeptical, quite skeptical actually about this, but we might want to look into this. Different data feeds, there should be no self-interest arbitrage, and as many wholesalers and other stakeholders have pointed out, using private data feeds could be required for meeting the best execution standard, and Doug has mentioned it several times. Multiple functions of wholesalers. There are potential concerns about dark pools, and there is another theory about the DMM role, but I'm skeptical about that argument as well, that the DMM somehow inflates spreads on the lit markets to benefit their wholesaling business. Delays, there have been some enforcement actions about that, and of course, I think the applicable FIN rule is outdated. Next slide, please. Okay, potential solutions. Banning PFOF or zero commission model, I'm skeptical about that because you would have to reassess all the incentives holistically. A pass-through for PFOF, a similar problem, difficult to implement, but other methods are more promising. For instance, enhanced disclosure, and in addition to more granular data, what about standardized disclosure of order flow arrangements? If price improvement, the price improvement PFOF split is being explicitly negotiated, why not disclose that? Rule 604, there is an exemption for displaying non-marketable odd lots, but perhaps it could interfere with best execution. Next slide, please. Okay, my final observations: reforming the tick size regime. As I said, as I mentioned earlier, the European regulatory regime offers some valuable perspectives here, because probably the tick size regime, a more sophisticated tick size regime, should apply to everyone, to exchanges and wholesalers alike. And finally, there are many complex solutions here, but we need to be mindful of the limits to social engineering. And fortunately, we have Hitesh here, has an excellent paper out there. Okay, I think that's all for my summary. Thank you.
Thank you, Stan, and we'll get a chance to continue the discussion on these ideas as we move toward the discussion among the members of the IAC. Now moving to Larry Tabb. Larry, welcome, and looking forward to your comments. You have the floor.
Hey, Debbie, thanks. Adam, if you could, or whoever could put up my slides, that'd be great. I'm Larry Tabb, head of market structure research for Bloomberg Intelligence. Bloomberg Intelligence is the research arm of Bloomberg LLP. So you can go to the next slide, which is my bio, and you can kind of skip over that, except I've been in this industry doing research for a long period of time. Okay, first slide. This is percentage of flow matched off exchange. This is the TRF. You can see it going up from about 11.5% in February of 2004 to almost 50%, 47.2% last February in the meme stock craze. It's basically had and the reason I have this here is most retail orders get executed by market makers off exchange. So a good portion of this flow shows up in the TRF numbers, and you can see starting when zero commissions occurred in September 2019, retail participation has gone up pretty extensively. Next slide. This is our view of where retail flow is in terms of a percentage of all shares traded. In the first quarter, we think it went up to about 24%. We think it's on the way down now. We think it's back down to 20%, looking at some of the volumes for the last month or so. But certainly, there's a lot of flow coming in from retail with the meme stock stuff and pandemic and zero commissions. Next slide, please. So this flow is concentrated in 6 major wholesalers: Citadel Securities, Virtu Financial, G1 Execution, which is Susquehanna, 2 Sigma Securities, UBS, and Jane Street Capital. This is the aggregate number of shares they executed via the SEC 605 reports over this quarter. And you can see in March where there's quantities on the right-hand side. Citadel Securities roughly did 5 times what the 3rd largest player did. It's certainly very concentrated. That said, it's actually very competitive, and we'll talk about that in a slide or two. Next. This market, as most people have been talking about, is driven to a certain extent by payment for order flow, or PFOF. The amount of payment for order flow from the first quarter was 481 million from the largest 12 self-directed online mobile brokers. It's a lot of money, and you can see the larger players are kind of written in white on the left side of your screen. It's a lot of money. That said, next slide. This is a data that fewer people see. This is price improvement. So for equities. While payment for order flow was 480 million for the first quarter, price improvement was 1.2 billion, or roughly almost 2.4 times the amount of paid in order flow payments, and it equaled, when you divide it all out, about a half a cent per share for each share routed to a major wholesaler, one of these six guys. Next. This is how the retail side looks at best execution. It's called effective quoted, or EQ. It's basically the percentage of half the spread that the wholesaler keeps. So the smaller the number, the better, not the larger. And so you can see in orange there, the average for March was 63.39. That means that the wholesaler kept 63.39% of half the spread of each share they handled. Or the other side is that the retail investor captured 37.31 or 71, 37.71. Next screen, and we'll talk about how that gets allocated. So here we are with a 1 penny spread, a bid of 20, an offer of 20 and a penny, a midpoint of 20 and a half. What we're talking about is in the middle, that half cent. How is that allocated? 0.183 cents goes back to the investor. That's price improvement. That's the investor saves. They're not paying 20.01. They're paying 20.00817. Now the other question is the balance of that half cent. Where does that go? That 3.17. Well, that goes to the market maker, but then out of that, they're paying for payment for order flow, which is roughly about 15 cents per hundred, or 0.15, and the market maker's keeping 0.167 cents. So in effect, the investor's actually getting more money than the market maker keeps, and more money than is given to the retail broker. So the retail investor's actually benefiting pretty well by this. Next. How can the retail investor get a better price than what's displayed to the market? Supply and demand. This is from only 4 of the largest market makers since January 2020, when a lot of this, when we started tracking some of this. And each of these different lines represents different trade sizes. And you can see the 100 to 500 share blue line at the bottom. That's the best execution because it's the smallest trade size. 500 to 2,000 shares gets a little worse execution. 2,000 to 5,000 shares gets a little worse than that. That's the green line. And the magenta line, 5,000 to 10,000 shares, gets the worst execution. Again, supply and demand. Larger order sizes push prices. And you can see it's an EQ of 108, which is wider than the bid offer spread. Next slide. So while this process does serve retail, as you saw, retail gets a little bit more than a third at half the spread. This is really not the best market structure. No, the market's extensively fragmented, and some folks in the early morning talked about this. There's 16 exchanges. There aren't 40 ATSs to trade equities, only 32 represented by FINRA. And if you look at FINRA, there are 223 max internalizing brokers that that execute orders directly. So in effect, there are 271 venues to get your order filled. Negotiating this is complex. As we saw, a ton is getting traded over the counter in February it's 47%, almost 50% getting traded OTC and less accessible to other investors. And order flow payments create perceived and possibly real conflicts. Next slide. Should we ban PFOF? I don't believe so. Again, the retail investors getting a good more than a third of this half the spread. It subsidizes zero commissions. If brokers didn't take the PFOF, they're probably or if brokers had to build out their own trading desk, that would create other conflicts. And the wholesalers, even though they're concentrated, they're actually easy to swap out. And instead of competing against these guys, you're using them to compete for you. And also there are other issues if this flow goes directly to exchanges. There are rebates. You talked about traditional rebate markets and inverted. So the retail brokers could actually get rebates on all of their orders depending on which exchanges they sent them to. And even without PFOF, a lot of brokers use market makers to do their executions. And as someone said earlier, other structures would possibly develop around this as well. Next. And my last slide. So what would I recommend? Better transparency. Update the 605 reports. The reporting gaps can possibly be manipulated. Certainly finer time increments. The fastest time period is 1 to 9 seconds, and orders are executed in milliseconds and microseconds. So broker price improvement reporting. Right now, the wholesalers have to report that, but the brokers don't. So Virtu may give X amount of price improvement, but you don't know what happens at Robinhood or Schwab or Tasty or Fidelity or whoever. Odd lots don't fall in the 605. Benchmarks. So let's, snap the NBBO on the confirmation and let people know, what is the spread that they're actually paying. Also, improve timeliness of data. We talked about that. There's controversy about that. Certainly slower SIP feeds can be manipulated, but generally investors are using SIPs and they're over an internet connection, so they're not really looking at direct feed prices. Certainly, we've got to improve the odd lot price. The process, the commission just put out a rule around odd lots, but it's still pretty confusing. Yes, odd lots need to be put into level 1, but does level 1 prices show up on my Schwab screen or my TD screen or my Robinhood screen? It'd be nice if I could, as an individual investor, would actually see that odd lot price. Tighten spreads. NASDAQ has a flexible tick proposal that's interesting. Also, Europe and other markets are starting to move towards a demonstrable or demonstrable best X. So instead of just saying the broker has to give you best X, make the broker prove that they're giving you best X. I think raising the bar in terms of best X actually would actually be beneficial to investors. And with that, I'll turn it back to JW.
Well, thank you, Larry. And next we have Hitesh Mittal. Hitesh, go ahead.
Thank you, JW. Good afternoon. I want to thank the SEC, my fellow panelists, and JW for moderating this panel. I'm the founder and CEO of BestX Research. We are a financial technology firm that helps institutional investors lower transaction costs through sophisticated execution algorithms. We believe that understanding the idiosyncrasies of market structure is key to delivering performance. And as practitioners of market structure, we also feel we have an obligation to elevate the conversations that make our markets better overall for investors. With that in spirit, my colleague Katie Burko and I recently co-authored a research paper called The Good, the Bad, and the Ugly of Payment for Order Flow. We mainly focused on two aspects. What is the impact of the wholesale market structure on retail execution quality? And what is the impact of the wholesale market structure on other market participants, such as institutional investors and other market makers? Our conclusions are as follows. First, we considered the retail investor's perspective. The argument in favor of wholesale market structure often is that on their market orders, retail investors receive better spreads, as we just saw in Larry's slides, with a wholesaler than they would at an exchange. There are counter arguments, however. that there is odd lot liquidity at exchanges that is not visible in the NBBO spread. So they may get that price improvement anyway. But even after taking that into account, we find that retail market orders on average receive price improvements for about 15% of bid-offer spread. So retail investors indeed receive better execution on market orders than institutional investors. And that's what we call the good aspect of wholesale market structure. But the fundamental issue is that the spread retail pays should not be compared against the spread on exchanges. And that is because the nature of order flow on exchanges is very different from retail order flow. Spread, the cost market makers charge to investors, is made of mainly two components: the adverse selection cost that the market makers themselves face and their profits. The adverse selection cost is simply the adverse price moves faced by a market maker after they receive an execution. Because the market orders in general are more informed than limit orders, prices tend to go down after a market maker buys and up after a market maker sells, in favor of the market order and against the market maker. And since the market flow at exchanges is much more informed than the retail market flow, the adverse selection costs are much higher as well. So if the cost of providing liquidity in exchanges is different from providing liquidity to retail, how is it that the NBBO spread at exchanges is a fair benchmark for retail execution quality? So to truly see whether retail really benefits from price improvement, you have to really look at how much the spreads themselves will go down if retail flow were to move to exchanges. And that's exactly what we studied. Analyzing TAC data, we estimated that adverse selection costs against exchanges market flow is about 60% of spread. So if you go back to what Larry presented, that's basically 120% in favor of the investor. So 60% of spread, and against retail flow, it is only 10% of spread. That is difference of pretty much the entire spread on a round trip of a buy and sell transaction from a market maker's perspective. So taking into account the differences in adverse selection and the relative volume of retail and exchange market flows, we estimated that if retail market orders were to move to exchanges, the spreads will go down by approximately 25%. So it's important to note that these spread reductions are far greater than the price improvements that retail investors currently receive. Also, the benefit of lower spreads apply to all investors, not just retail investors, so a lot larger in magnitude when measured in terms of dollar savings to all investors. So far, I've discussed market orders, but what about limit orders? One of the great characteristics of an all-to-all market is the ability for investors to completely disintermediate market makers by submitting limit orders to exchanges or to ATSs. With the electronification of trading, institutional investors make great use of limit orders to minimize trading costs. These limit orders from institutional investors now face higher adverse selection costs, just as market makers' orders on exchanges, due to not having the opportunity to interact with retail market orders. But leaving institutional investors aside, one of the greatest ironies of wholesale market structure is that the retail limit orders themselves do not interact with retail market orders. Wholesalers trade against the retail market orders to earn spread, but they route out the limit orders to exchanges. Thus, the retail limit orders face off against the same market orders that wholesalers themselves are trying to avoid by segmenting the market. The most important issue, in our view, however, is much, much broader, and it's the issue of information asymmetry among market participants. At exchanges, there's competition for every market order that arrives. The limit order with the best price wins the trade, but there is no such order-by-order competition in the wholesale market. Lack of competition on an order-by-order basis leads to a sort of oligopoly in wholesale markets, because without that, it is hard for a new market maker to compete with established players. The concentration and lack of competition is evident from 605 reports. Larry just presented some of those numbers. Just the top 5 wholesalers trade about half the overall volume on what trades on exchange limit order books throughout the day. And in many stocks, just one wholesaler alone in our study was more than half of the entire equity volume. Wholesalers clearly have an information edge versus other market makers who are competing with them on public exchanges. We don't believe that the private information itself that they obtain is being obtained nefariously, as wholesalers are entitled to use that information about the order flow to predict the direction of future order flow or the stock prices. But with that information edge, they can price quotes much more efficiently than others can. For example, if based on private information, a market maker believes the price is going down, they will obviously quote their bid on public exchanges below the national best bid. And a market maker at the national best bid will be catching the falling knife, getting adversely selected. Over time, this information asymmetry is likely to drive other market makers out of business and increase concentration even further on public exchanges. The more information asymmetry there is, the higher the spread. This can create a vicious cycle because wholesalers only benefit from higher spreads with the current PFOF arrangements. This information asymmetry and the impact of this information asymmetry, which we cannot quantify, is what we call the ugly aspect of wholesale market structure. The last thing I would like to say is this. The SEC should think about not only whether investors are receiving best execution within the current regulatory framework, but whether investors could receive even better execution under an alternative market structure. But unfortunately, that alternative market structure cannot be arrived at by efforts from some market participants alone. And that's due to network effects. For example, even if one retail broker does not receive PFOF and wants to decide to route order flow to exchanges, they will still have a competitive disadvantage versus other retail brokers who will still send order flow to wholesalers and get that price improvement. It's a classic case of prisoner's dilemma in game theory, and that can only be resolved by improving the game, the market structure itself. So what can the SEC do? Unfortunately, more transparency or even banning PFOF, while they will help resolve conflicts of interest, are unlikely to result into that kind of an outcome. The issue is much more deeply rooted into other asymmetric rules that exist in the market structure. We have different set of rules for different participants. First, lack of obligation to check prices with multiple dealers on an order-by-order basis for a retail broker. Yes, there is competition in the market, but that's not on an order-by-order basis. It's very similar to NYSE having multiple specialists, but for a given stock, there was one specialist. Even in other asset classes that trade 100% over the counter, brokers have the obligation to check prices with multiple dealers before they fill a client's order. But that does not apply to retail brokers in equity markets. Second, single dealer pool's ability to segment order flow in a much more granular way than an exchange can or an ATS can. Third, single dealer pool's ability to price at a fraction of a tick, but regulated venues not having the same flexibility. And finally, fair access obligation that only applies to ATSs, something that Stan touched upon, I guess it happens in Europe. Fair access obligation that only apply to ATSs when they cross a certain volume threshold, but that is not applicable to single dealer pools. I believe all of these asymmetries will need to be looked at by the SEC in order to improve markets for investors. I look forward to providing my viewpoints and, as always, learn from other participants. Thank you again to the SEC for this opportunity to be on this panel today.
Well, thank you, Hitesh. And Doug, you have the floor. Looking forward to your comments.
Thank you very much, JW. Appreciate that. Good afternoon, and thanks to Chairman Gensler, committee members, and fellow panelists, and the SEC staff for inviting me to participate in today's meeting. My name is Doug Sifu, and I am the co-founder and CEO of Virtu Financial, a leading financial services and market-making firm that provides deep liquidity and competitive bids and offers in over 25,000 securities at over 235 venues around the world. Slide 2, please. Today's meeting and the important topics being discussed could not be more timely as we reflect on an unprecedented series of events that has intensified the dialogue around equity market structure. For several months, in the wake of trading volatility involving so-called meme stocks, policymakers and other commentators have been questioning whether our markets are broken. Many are urging the SEC to consider changing the rules governing routing of order flow, enhancing disclosure requirements, and re-engineering how market participants get paid for the services they offer. More than ever before, there is a focus on the retail investor experience and on ensuring that our market structure protects their interests. At Virtu, we welcome the robust dialogue that is taking place. We believe the events of early 2021 have resulted in a healthy debate around the regulatory framework that governs our capital markets. However, we are concerned that the growing intensity of calls for reform is not only based on false narratives and factually unsupportable conclusions, but also obscures the fact that the U.S. equity markets are the most robust, transparent, and fair in the world for all investors, and for retail, the investor experience has never been better. Developments in market structure, advances in technology, and the introduction of intense competition have resulted in vastly expanded service and product offerings for retail investors, low or no cost trading, and importantly, superior execution quality. Consider how far we've come. Today's retail investors can pick up their smartphones, enter an order, and get near instantaneous execution at prices at or better than the national best bid or best offer in over 8,000 listed securities. Slide 3, please. The benefits of today's market structure to retail investors are quantifiable, and the supporting factual evidence is striking. Today, rather than engaging in conjecture and speculation, I will provide you with facts and data. For example, under the current model, wholesalers fill marketable orders at prices typically better than the NBBO, regardless of the number of shares displayed at the NBO. The combination of price and size improvement offered by wholesalers, which we refer to as real price improvement or real PI, translates to real dollar savings for retail investors. In 2020 alone, Virtu contributed approximately $3 billion of real PI to retail customers' orders it handled. That real PI benefited retail investors, and it's about 3 times more than what is reflected by the data collected under Rule 605. This demonstrates a significant understatement of the true benefits recognized by retail investors under the current market structure. By contrast, real PI quantifies the actual benefits to retail investors by benchmarking executions against the actual size of resting orders on exchanges, a more realistic proxy for execution quality obtainable in the absence of the wholesaler model. All of this data and analysis was publicly filed by Virtu this morning and is available at sec.gov. Certain critics of current market structure have focused on the omission of odd lot orders from price improvement calculations under Rule 605 as a reason to discount reported price improvement figures. We agree that odd lot orders should be accounted for in measuring execution quality, both resting odd lot orders and marketable odd lot orders, as should short sell orders, which are also excluded from the existing methodology. However, including these types of orders would only marginally change Virtu's 2020 PI. Resting odd lot orders would decrease the figure by 3%. Marketable odd lot orders would increase the figure by about 11%, and short sell orders would increase the figure by 3%. Properly accounting for the number of shares available and calculating price improvement, on the other hand, size improvement, would increase Virtu's 2020 PI by approximately 210%. Again, demonstrating that price improvement reported under current Rule 605 substantially understates the benefits to retail investors provided by the current market structure. Again, all of this is now publicly available. Another theory put forth by critics of the current market structure is that the bid-offer spreads are widened by the wholesale model, and specifically the segmentation it has introduced. They posit that spreads would mythically narrow if executions all took place on a lit exchange. We posit that the opposite is true, and real data from the Commission's tick size pilot provides support for that thesis. For securities in Group 3 of the SEC's own tick pilot, the group that included a, quote, trade at requirement, which removed much of the segmentation, and forced more trades on exchanges, spreads in fact widened when compared to the control and other test groups. They widened. This is frankly unsurprising to us and provides some important insight to what might actually happen if the current market structure is drastically altered. Investors will pay more in implicit transaction costs, and retail will lose much of the benefits they have realized on the current model. Slide 4, please. Today, wholesalers fill most marketable orders at prices that are better than the NBBO at the time of order arrival, and the vast majority of orders receive at least the NBBO or better. Virtu could not provide that result by simply routing orders to the exchanges or even to a combination of exchanges and ATSs. We know this because when we route orders to exchanges, ATSs, and other market centers, we only obtain price improvement for approximately 18% of these shares. To remain competitive, we incur significant expense to provide supplemental price improvement from our own pocket to orders filled in this manner. Based on this data, we conclude that retail broker-dealers would not achieve the execution quality they currently enjoy by routing their orders directly to exchanges and to ATSs. And let's not forget that retail brokers have a legal obligation of best execution, which they meet by routing to venues that provide the best price and size execution, not the ones that offer the most payment for order flow. Slide 5, please. Retail orders also benefit from intense broker competition promoted by the current market structure. It has led to low or no-cost trading because wholesalers, including Virtu, absorb all of the lit exchange and ATS costs, which would otherwise be passed on to the retail investor. These costs are significant and serve as further evidence of the benefits of the wholesale model. In addition, broker-dealers can leverage the risk management capabilities and economies of scale from wholesalers and pass on the benefits to their customers. The current construct also allows broker-dealers to compete on other factors: research, trading tools, investor education, trading interfaces, and financing rates, among others. Slide 7, please. I'm jumping a little bit, sorry, my style. Finally, it is simply not true that there is a lack of competition for retail order flow. Retail investors benefit from a competitive and resilient execution ecosystem. There is intense competition among at least 8 wholesalers that compete against each other with low barriers to entry and new entrants on a regular basis, as well as approximately 32, as Larry said, other liquidity sources, including exchanges and ATSs. Brokers can currently route to many execution partners and exchanges, mitigating single point of failure risk and making marketplaces more resilient. While we support data-driven reform, we worry that a drastic overhaul of the current market structure could bring about unintended consequences that would actually harm retail investors. Instead, we believe that changes should be focused on updating Rule 605 by enhancing transparency so that the existing benefits to retail investors are accurately reflected in the data that is reported by market participants. Please go back to slide 4. In our view, the logical starting point for any potential regulatory enhancements is Rule 605, which we believe has significant gaps in the completeness and granularity of data reported and thus presents an incomplete view of execution quality. For example, in an attempt to measure fill quality, Rule 605 reports compare the fill price on marketable orders to the NBBO. This has significant limitations. First, the rule ignores the size of marketable orders relative to the shares at the NBBO. It essentially assumes there's limitless size at the NBBO. Second, the benchmark, the NBBO, by definition, does not include unprotected displayed odd lot orders. Third, marketable orders for less than 100 shares, so-called odd lots, are excluded entirely from the data set. Finally, short sale orders are also excluded from the methodology. As a consequence, we believe these reports provide an incomplete picture of execution quality, and we would support collection of more comprehensive data to reflect how wholesalers offer both price and size improvement and to more accurately reflect the benchmark of available visible liquidity. Again, in my written materials, we have quantified the impact positively and negatively of these enhanced disclosures as applied to our 2020 605 data, and the enhanced real price improvement numbers are striking. Notably, we are not alone in calling for changes to Rule 605. Just 2 weeks ago, my friends at NASDAQ published a piece critiquing the rule, reflecting a growing consensus across the industry for more comprehensive reporting requirements. A model for the SEC to consider is an initiative of the Financial Information Forum, in which participating broker-dealers can voluntarily publish much more refined statistics than what is included in existing Rules 605 and 606 reports, such as taking into account order size, and measuring execution quality. We are engaged in this program and strongly support its objectives. We believe that the program could be a model for reforms to the SEC's existing requirements to better reflect the benefits investors receive under the existing market structure. We urge the Commission to look carefully at the findings of this initiative as it considers ways to enhance transparency around quality of execution of retail orders. Thank you again for the opportunity to participate today. At this critical inflection point in the evolution of our markets, it is of paramount importance to keep in mind the immense benefits the existing system offers to retail investors. While there are changes that should be considered, it is important to proceed cautiously and deliberately to ensure that those benefits are not compromised. Virtu looks forward to being a resource to the Commission on these initiatives, and I'm happy to answer any questions. Thank you, JW.
Well, thank you, Doug, and thank you for providing data sets. I'm always a fan of that as an academic, so thank you for that. All right, we'll move to first open up the floor to questions from members of the Commission. Do any of the commissioners have any questions they'd like to ask? Just to give you a second, if you'd like, but we won't put you on the spot if you just want to listen and digest. And as we go forward, please let me know if that changes. Okay. Let's see. We have first up in the queue. The queue that I have now is Jennifer, and then Jamila, and then Alice, and then Brian, and then Mina. So Jennifer, go ahead.
Thanks, JW. And thank you to the panelists. I want to echo JW's comments that sharing the data and statistics that you have here today are just much appreciated. And of course, sharing them publicly. So Larry, I want to start with you because you had a recommendation at the end of your talk that brokers somehow show their best execution, that they've achieved best execution. And one of the things that we talked about in our morning panel is that best execution, there are a lot of factors that go into that. It can be a complicated concept. So do you have any specifics to provide about your recommendation to brokers on that issue?
Good question. Well, first, yeah, I'm not muted. Good. First, it would be great for the brokers to actually display their price improvement statistics. So right now we get them from wholesalers, but we don't get them from brokers. So I can't tell if I'm going to get better price improvement from Robinhood or Schwab or TD or Fidelity or whoever. That would be a good start. The second would be strike the NBBO and the bid offer on the confirm or in the email back to me or the NOE, the notice of execution, so that I know that, okay, this is where I got priced and this was the bid offer and the midpoint of when they received or submitted the order. For institutional side, I think it gets a little bit more complicated because I think when you're dealing with size, price may not necessarily be the sole criterion. And you're starting to see the MiFID best execution requirements push the brokers to really demonstrate their routing and how they route and why they're routing to the places they route to. That's probably a little less important for retail, but I think a more rigorous view of what the conditions in the market were in the stocks and what's the history and why and the ability to query the brokers and get a better understanding of why they routed would be a good thing.
Okay, Jamila, you're up next.
Thanks. And thanks to the panel. It was a very engaging discussion, and I wanted to pull on some threads. So I think Larry, you and Doug made it clear that, there's real price improvement, different numbers and different looks at the data. But Hitesh's argument around the information asymmetry or lack of symmetry really was provocative to me. And I wanted to get your responses to that. Because I think, Larry, you said you thought things were competitive, not necessarily, in any way an oligopoly, like Hitesh said. And then Doug, I think I kind of know where you would land on this, where, hey, this isn't necessarily an issue at all. It's not something you mentioned. And then Hitesh, maybe you can respond, but I thought that argument was circling around from hearing all three of you speak, and would love to get Larry, you first, just to respond to that, the asymmetry of information.
You know, theoretically, economic principles would say that all orders competing against each other all the time is the best way to get the best execution. On the other hand, as I noticed, there are 16 exchanges, there are 32 dark pools that trade equities, and up to 225 internalizing brokers. Okay, you know, you get rid of 6 wholesalers, there's still 220 venues to go to. So you've got to think about, you know, what do you do about that segmentation? And then you've got segmentation within the exchanges, depending upon, you've got maker-taker, taker-maker, fee-fee. There's a lot more segmentation going on. So just getting rid of PFOF or forcing orders away from the 6 wholesalers, you got blocks, you've got facilitation trade, you've got all sorts of stuff going on at traditional brokers that you would have to think about killing to concentrate that flow, even at the exchanges. And theoretically, you shut down 15 or 16 exchanges. So I'm not sure people would be very happy with that scenario. And if you're just talking about getting rid of 6 or 8 wholesalers, I'm not sure you're really, they have a lot of concentration in the market. I think you're better off getting better data and better transparency and letting investors and their brokers make better decisions. Unless you're really radically going to go shut down 224 venues.
Thanks, Larry. Doug, anything to add to that?
I always have something to add, you know me, right? Well, look, I mean, there's a couple things, just to clarify a point, which, I heard actually the chairman mention yesterday, and I know it's not quite the question you asked, but I'll answer it anyhow, which is from there's been some comparisons of the wholesalers to Facebook, right? Like somehow we have like client level information and that data is valuable and somehow we're reverse engineering things. It's categorically false, right? The retail brokers do obviously a great job of managing the privacy expectations of their clients, right? So there's zero client information out there. Obviously, every time we execute a market order, instantaneously there's a print to the TRF, right? And it's a sub-penny print. So anybody in the marketplace sees that Virtu, as I'm speaking, is buying or selling Tesla. And so is Citadel, and so is Susquehanna, and so is 2 Sigma, right? It's all reported to the TRF. So the information's out there. Sophisticated market participants are able to homogenize it and synthesize it. If there's an information asymmetry in the market, as Hitesh acknowledged, it's really the market maker. We're sitting here two-sided in 8,000 symbols, right? And when a market order gets sent to us, whether or not we internalize it, the client is done. Right, and so we're going to get run over in a bunch of names throughout the day. So this is not all like unicorns and rainbows over here at Virtu, right? It's a very challenging business to be in, and it's highly, highly competitive. And the most important thing, and again, it's one of these false narratives that's out there in the ecosystem, is that somehow the retail brokers are abrogating their best execution obligations by routing orders based on payment for order flow. It's not true. It's categorically not true. I mean, we compete with 5 or 6, 7 great wholesalers solely based on the service that we provide, i.e. a guaranteed execution, and most importantly, the price that we provide in aggregate to their clients. So what is the amount of execution quality we're able to produce? The only other comment, Larry, I never want to criticize you, right, because you're terrific, but the price improvement statistics are out there. I watch CNBC all day, and there's a retail broker whose name starts with an S that runs a bunch of advertisements of 2 lovely fellows sitting down having lunch, and one of the guys says, "I'll pay because I saved $12.63. He's obviously not in New York because lunch costs a lot more than that, but at the end of the day, that's what retail brokers are competing on, right? They're advertising based on that. And firms like Virtu and Citadel and Susquehanna and 2 Sigma and UBS and others that are competing, that's what we're competing on to provide that level of service back to the great retail broker partners we have. There's 200 of them. They're routing based on price improvement, and the information asymmetry actually runs the other way.
The other thing I want to add, and not to criticize Doug at all or anything, but if all of a sudden I'm a retail broker and I decide I'm going to go directly to the market, not only am I, not using someone like Doug or whatever to protect my orders, I'm actually going to be competing with Doug because he's going to be trading on all those orders I put to the exchange. And I would much rather have him behind me, backstopping my orders and giving me size guarantees and make good guarantees and stuff like that. And all of a sudden, I'm competing directly with him on every single order. So that's problematic as well.
Hitesh, I know you want to jump in here, so.
Yeah, thank you for this question. I think the issue is, I'm not going to say that they should shut down 5 or 6 wholesalers. I would say that there should be more. And among those 5 or 6 wholesalers, there's one.
Bring them on. Bring them on. There's no barrier, right? Two new ones just started. Sorry to interrupt, but there's no barrier. Come on.
So among those 5 or 6 wholesalers, one has the 50% market share and the other 25%, right? And that's for a reason, right? That's for a reason, and the reason is that the competition, as I mentioned in my talk, is not order by order basis, right? So if Robinhood decides to route order flow, they have a routing table, that all of this flow is going to go to this wholesaler or that wholesaler. So on that particular order, there is not competition. If a market maker who could provide a better bid to that seller, to that sell market order, they don't have the ability to do that, right? When I go to an exchange with a market order, that happens. The best bidder will win. The best bidder could be an institution who wants to buy. It could be a market maker who has 0.01% market share. But at that point in time, that market maker is willing to buy at the better price than a Citadel or a Virtu can, right? So that competition disappears, and I think that's a challenge. And the second thing I would add to the information asymmetry part, Doug mentioned that all of these trades are available in TRF, and he's absolutely right about that, right? But and they do provide a fill first before they before they think about how to hedge that or whatever they have to do with that. So I agree with them on that as well. But if you have this captive flow, if you are getting 80% of the GME order flow, and where it's coming from, right? That is information. You can use that information to predict what the other future order information is going to be, and that's a big edge. They have, Virtu, Citadels, a lot of these wholesalers, they run their ATSs, right? So they can make markets to retail in their own ATSs where they will not have this information. So why run a single dealer pool if you have other venues where you don't get that information and you can do the same things? You can make markets within those ATSs, but they don't do that because there is that extra information, and information is powerful, and they don't do that illegally, right? They use that for predicting what's going to happen in the future. So, and that's an edge they have. And as the amount of information sort of gets larger and larger, that's when it becomes a problem. If, retail was 3% of the market and or 5% of the market, and it was distributed between, among 10 dealers, that's okay. But if it is 25% of the market and, take out opening auctions and closing auctions is almost 50% of the market, and that's going to 1 or 2 dealers, and the same market makers are also making markets on exchanges, the other market makers are going to be on the losing side.
If I could make a quick comment, just to back up Hitesh on the issue of order by order competition, from a comparative perspective, in Europe, systematic internalizers / wholesalers are required to stream quotes. So at least theoretically, there's a possibility of competition on an order by order basis. I'm not sure how relevant it is in practice, but and probably it's not something I would advocate for the U.S. markets. But it's just an illustration how an order by order competition could be carried out.
Can I just add something to that, Stan, really quick? Sorry, JW, to
Sure.
jump out of order, but just Stan, if you can clarify, because when you stream prices, I think it's on only a select number of tickers where you might have access, so you don't have to stream your entire book. And so I think there would be limitations to that. So I'd be curious what you all think.
Definitely.
Yeah.
But my
And
point
another
being
another point of order, there's no price improvement, Stan, unless it's large in size, right? So it's you're really talking apples and oranges.
yeah, like, we can't
Right.
directly compare those.
Right.
regulatory
So it kind of means nothing, right? If we just stream at the touch, that's kind of what we do on an exchange. So the European example doesn't really matter all that much.
Yeah, you
But
can
I think-
only
I think-
price
I mean,
improve-
Yeah, I mean, I'm
you
like
can only
just
price improve for large and scale, I think, in Europe.
exactly. That's what I just said. Yeah, thank you,
Large
Larry.
is an average.
Yeah, I mean, I think just taking a step back here. I mean, I think, and again, I'm not trying to criticize these panelists. I mean, they're terrific guys and they're really smart, thoughtful people, and they put a lot of good work into this. But I think the supposition underlying their critique, which is not based on data, is that these large retail brokers that have resources that are far in excess of Virtu Financial, you know their names, they're my clients, right? That somehow they're not capable of reaching the conclusion that they're getting better execution quality by taking some of their order flow and routing it to wholesalers and some of it to exchanges. All the statistics are out there publicly, right? These are large multi-billion-dollar companies that have unbelievably talented folks and billions of dollars to spend on technology and understand market structure, and somehow, some way that they're not satisfying their best obligations, they put us in real active competition with each other, right? And it's not order by order. That's just not a practical way to run a marketplace when there are literally millions and millions of orders that are being sent pre-market and during the day. But every single day, there is input on the level of service and execution quality. And there's a wheel every day that in many cases gets readjusted every day. So this is a very fluid, intense, competitive marketplace. So the realities of how the market works is really not reflected in the comments, right? It's just not factually how the marketplace works. And I think it's a little naive to assume that these brokers, which have unbelievable experience and resources, somehow are abrogating their responsibilities, are not capable of concluding whether they should route to an exchange, to an ATS, or to a wholesaler.
Well, what you just to jump in for a moment here, what you leave out of your description, Doug, is the suggestion that the conflict of interest posed by payment of order flow leads these sophisticated parties who may very well know exactly what you described to ignore that fact. And that's a difficult issue. And the ultimate retail investor is not going to pay attention to any of this stuff. The Robinhood app users are not going to pay attention to any of this. That's the question.
Here's what I would say, JW. Look, there are business conflicts in everything that we do. We have an institutional business, right? As it sounds like Hitesh does as well, right? And we get an order from a client. We're an agent acting on behalf of a principal. I have a conflict that I would rather they trade more. I probably would make more money if I routed it to like an inverted venue or depending upon some removal order, this or that, right? Those are conflicts that exist all over the place in the financial ecosystem. They're there. We deal with them not through banning or prohibiting. We do them through disclosure and analytics to ensure that the agent is acting appropriately or in the best interest of the principal. So in my institutional business, we've got 2,000 institutional customers that depend on Virtu for order routing, right? And so we've been very good and very front-footed about saying, we're going to route in your best interest, not to maximize our profits. There's a conflict. We've disclosed it. We provide real-time information on that and tags to demonstrate that we have satisfied our obligation. The supposition somehow that retail brokers are not capable of managing that conflict and that through disclosure, I understand that there's been fines that some retail brokers have paid for bad acts. I get all that, right? That's the SEC's job, and kudos to the SEC for doing a great job. But we don't deal with conflicts, as a legal matter, as a business matter, by saying, we're going to ban that activity. Look at the research analyst scandals in the late 1990s. Investment banks still have research arms, don't they? Right? What do? They've got all kinds of disclosures and Chinese walls and things like that. So there's a better way, JW, to deal with payment for order flow through disclosure, right? And maybe, as Larry said, put it on the confirm. I don't care. I'm all in favor of enhanced disclosure. But to say we're going to take this enormous baby, which is $3 billion of value for Virtu, and we're literally just going to toss it out the window and create a commission trading environment, just to me is not the practical answer.
Yeah. Well, I appreciate that, though. I would note your fellow panelists also did not recommend a PFOF ban. And I would also note that, maybe not everybody maybe not every institution is as good at managing these conflicts of interest as you are. And those are things to consider too, But I'm monopolizing here, and I know we have somebody else in the channel here. Brian wanted to go next and build on Jamila's point. So we'll just keep the discussion going, but bring Brian in because Brian's been waiting. Go ahead.
Yeah, thank you. I wanted to just extend this exact conversation because it seems like a lot of the assertions being made about what would be the right thing to do and who benefits from the current situation is based on this idea of price improvement. And the price improvement is being calculated against that NBBO price. So I believe I heard two very different suppositions from the panelists. One, that the price improvement calculation is flawed in a way that if we fixed it, it would be very much less a price improvement for retail investors. And another, where if we improved upon how we measure the benchmark, it would be more price improvement for investors. So can we go back to that and try to get very concise, just summaries of why each of the panels, I believe it was Atesh and Doug, why you think that the benchmark could be improved and why you think it would result in the directional change that you offered in the talk?
Sure. I'm happy to go first. Well, what we did, Brian, was literally take our 605 data, and the criticism that folks have is that, well, the NBBO doesn't include, displayed odd lots. So we said, okay, we'll make that improvement for the SEC. We're going to voluntarily recut all of our 2020 data, giving the critics, for lack of a better word, credit, if you will, for the tightened spread by odd lots. It's one of these criticisms out there in the ecosystem, which I always kind of scratch my head at. We did the data, and so we lost 3% of our price improvement in 2020. However, if you're going to do that, what's fair is fair. Then if we get a marketable order for an odd lot, that's not counted by the 605 statistics as well. So we get no credit for price improving odd lot orders. And another thing that I always scratch my head about, the critics, there's some supposition that the retail brokers aren't clever enough to realize that they're sending odd lots and they should be price improved. That's wrong. It's factually incorrect, right? So we get credit for that. As well, for reasons that I'm not familiar with, 605 also doesn't include orders that are marked short sale. Right, so we price improve a bunch of those as well, around $20 million worth in 2020. So we credit for that. And then finally, and here's the sort of coup de grace, Brian, in terms of the shortcoming of the current disclosure regime. We get a marketable order from a client. Top of book NBBO is 200 shares. We get an order for 500 shares. The 605 reports, and the deal that we have with our retail customers is that effectively there's infinite size at the national best bid and best offer. So an institutional client doesn't have that expectation, but our deal with our retail partners is that is the case. So we get an order, 500 shares, 200 on the inside, 200 next level, 200 on the next. We effectively size improve and price improve that 500 share order, kind of assuming that there's 500 at the inside when there's not. So what ends up happening is Virtu, it takes that risk, so it removes the liquidity and effectively provides that level of price improvement. So if you aggregate, Brian, all of that size improvement, right, because often, it's not all Tesla that we get, right? There's a lot of Reg NMS securities. By providing that level of size improvement, give us credit for another 210%. So if you say A minus B plus C plus D, that gives you the $3 billion. So our suggestion, humbly, to the commission is, let's use the right data and the right facts. Let's provide that to the retail brokers. And as Larry said, put it on the confirms, put it on the website. I don't care because I'm proud of it. Hope that was concise enough.
So I think on this point, I think we are in agreement, Doug, Larry, and I, that there is price improvement. And I think that's what I said as well, that there is price improvement versus the NBBO spread, and they calculate numbers in dollars. We calculate in percent of spread because we think, that's sort of the best way to measure it, because the higher the spread, the more price improvement there will be. So we calculate that in percentage of bid offer spread. But the point I was making was the bid offer, that's assuming that bid offer spread will remain constant if the retail flow went to the exchanges, right? When you're using bid offer spread in exchanges, that is basically to say, hey, if you went to the exchanges, you would get this price, but if you go to the wholesaler, you'll get a better price. But the problem is that if they go to exchanges, because of the nice liquidity that they represent, because they are not as informed as the other market orders, the bid offer spread itself in the exchanges will go down. So that's sort of the point I was making, and the bid offer spreads will go down by 25% in our estimate. So that's sort of the contention here, that all of these sort of all of the marketing around wholesaling and PFOF relies on the fact that they're comparing themselves versus a totally different market, which has a totally different toxicity of the flow coming to that market, and that's just not a fair comparison. If that flow moved to that centralized market in some form or the other, then the bid offer spreads will go down.
And beyond the estimation techniques that you use to reach that conclusion, Hitesh, do we see evidence of that in other markets, other countries, things like that, that the spreads are tighter in a world where there's less segmentation and we don't have this pay for order flow and all of that? Is it? I mean, even that's not a perfect comparison, but I'm just curious if we have other supporting evidence for that idea.
I mean, the evidence is right here in our market, right? So we looked at stock by stock for Russell 3000 stocks, and we looked at, what is the bid offer spread and how much is the adverse selection? How much does the price move away from the market maker? The price goes down when the market maker is buying, and when the market maker is selling, the price is going up. So how much is the adverse selection the market maker faces on every stock, and what is the spread? And there is almost a one-on-one relationship. So, and then we measure, what is the adverse selection of the retail flow? And that's a lot lower. So that's about 10% versus 60% on the market flow that comes to exchanges. So from that, we basically imply that, the bid offer spread would be lower. The other point I will make is, wholesalers are providing lower bid offer spread, right? Wholesalers are making markets on exchanges where they're getting rebate, right, to make markets. And they can get bigger bid offer spread there. So they can get better spread, they can get rebate in exchanges. So why are they giving payment for order flow and still giving price improvement and still happy to be inside the bid and offer spread? Because there is lower adverse selection. There's no denying that. That's basic trading, right? So to ignore that fact that retail flow is less toxic and hence the bid offer spreads will go down in the exchanges, and to completely ignore that and say, this is the price improvement versus what the current bid offer spread is, that's a bit unfair comparison.
Yep. This is like point counterpoint. So allow me 1 minute to rebut. I feel like I'm back in high school debate, JW. Yeah, I think, look, Hitesh is well intended and he represents institutional clients, and I get it. I wish him well with his endeavors. But what he's suggesting just doesn't represent reality in trading, right? The reason Virtu is capable on 8,000 names to be so competitive and to narrow the spread is because of segmentation and Citadel and Susquehanna and everybody else. If we posted today the size that we are two-sided in 8,000 names on 15, I should know that, national securities exchanges right now, we would get trucked. We would get run over. And that's exactly what happened in SEC's tick pilot on 400 names that were sort of lower ADV type of names, right? So it's just not reflecting reality to assume broadly without any empirical evidence, because there isn't any, right? The only empirical evidence, the only real test that has been done in the marketplace actually proved the opposite. And that's because segmentation allows firms like Virtu and Citadel with a good deal of confidence to provide meaningful liquidity and size on a two-sided basis continually throughout the day. If we had to post that in a national securities exchange, and we do because we have a non-customer market making business as well, the size that we provide outside, on exchanges is dramatically smaller than what we do in our customer market making function, and for very good reason. That's sort of trading 101, right? We're trying to minimize the amount of adverse selection. So really, the suggestion that you're going to take this ecosystem, which has been built over 30 years, that provides this incredible amount of value, right, to a segment of the market, and throw it all away for this theoretical result that somehow spreads are going to magically narrow because Virtu and Citadel and the other competitors are going to continue to provide liquidity in the way they do on an exchange. It's just, honestly, it's fairy tale. It just does not reflect how trading works.
I feel like I'm in agreement with Doug. I'm in complete agreement with Doug that there is more adverse selection, and this is because of segmentation. So I don't know what the disagreement is. So Doug, would you agree that people would get run over less if this retail flow moved to exchanges?
No, because there wouldn't be the liquidity there. Like I just showed you the aggregate amount of size improvement. Retail's going to get a much worse experience, and we're not going to be there in that size. You ever hear of an HFT firm, right? If we posted the size that we were posting, we would get picked off day and night by HFT firms. You're just not reflecting the reality of how trading works. Right, we have tried to post more size on exchanges around the world. What ends up happening? We get dramatically adverse selected. So what ends up happening, Hitesh? The bid offer just widens.
Mm-hmm.
Okay, let's run an experiment, okay? Everybody that's not a wholesaler today, it's a market maker, market participant, 30% of the marketable orders that we get from clients we don't internalize. Okay, we want to mitigate our costs on those. So we route to exchanges to try to remove price improved liquidity. We go to IEX midpoint. Everybody that wants to interact with retail today, please post in midpoint at IEX. I'm telling you, we're routing there right now. Right, but unfortunately, and another real one, I put it in the data, only 18% of the time on that 30% of orders, so around 5% of those orders, get filled on a price improved basis. Why? Because it sucks to put liquidity out on an exchange in size, Hitesh. Unfortunately, that's the case. If it was not the case, we wouldn't spend a couple $100 million a year having to price improve those orders we don't otherwise want to internalize. So,
can I just ask an informational question on that?
Please.
So you've mentioned that you sometimes routing trades out to exchange midpoints, right? And Hitesh is in that isn't always the case. This reminds me a little bit of something we're going to talk about in the next panel, 10b5-1 plans. The chairman's mentioned, many people have mentioned, there's this issue of sometimes people decide to cancel the plan on an informed basis. Yeah. Same thing here. There might be informed decisions about what do you route out versus what you internalize. And if you make that decision first, doesn't that kind of bias what's going on here? No, because we have risk limits. We have this. We have that. No, I mean we every order that comes in, we're in the hole. Okay, we're in the hole because we owe sometimes we owe a rebate in the form of payment for order flow, and we owe meaningful price improvement. So whether or not we're going to internalize an order may have nothing to do with what we think. We may be at a risk limit. We may be, for whatever reason, we may have a technology issue here. So the notion that somehow where there's massive data and informed, it'll be more profitable to internalize and route out, or vice versa, right?
I didn't hear. I'm sorry.
It may be more profitable to make the decision whether to route out or internalize.
But we're taking the risk, right? As soon as the order hits our environment, JW, the order's done, right? So that client is filled at or better than whatever the MBVO was at that moment in time. When we go out to an exchange or to an ATS to try to, get price improved liquidity, if we don't, we're still going to remove at the touch, and then we reprint, that order back to the client on a price improved basis, right? So,
Doug, it's worth
we're losing money on every one of those I apologize, Brian. We're losing money on every one of those trades, JW. So
the risk that you're offsetting is risk that you chose to take by paying for the order flow in the first place.
Sure,
right?
Of course.
There's a different version of the world where things just work differently. So, I mean, you're obviously acting rationally and very professionally within the current status, or within the current structure. I think the question is there a better structure? And I appreciate the comments.
I mean, sure. Yeah. I just think it's all pie in the sky theory as against the reality of when we've tried this. we had a trade at rule, if you will, in the tick pilot for 400 names. Just go look what happened.
So one of the things I would add is, retail does not equal retail exhaust, right? So what Doug is talking about is, look, this is the flow they didn't want to put on the risk for, so they want to get rid of it, right? And when they want to get rid of it, obviously, instead of buying at the offer, they would like to buy at the midpoint, right? And that's exactly the point I made, that's the information asymmetry, right? So if they have the information, if they have better information, and they're trying to get rid of their risk, and they have better information than the market maker who is making market at the midpoint or, on the offer side, that market maker is going to be on the losing side.
All right, I want to be respectful of our members of the IAC. We have Mina next, and then we have Alice, who I think is probably going to have the last question. So Mina, take it away.
Sure. Well, I've worked with many of you, so I want to start by just saying thank you. I always like to thank the panelists. You choose to come here to share your views, and we appreciate it so much. Somebody had said earlier on the earlier panel that maybe Europe has a better market structure than we do, and someone who has spent a whole career at Treasury and other places thinking about U.S. capital markets, that saddens me. So today's lively debate, I think, is intentional in a sense that these are the conversations we should be having to think about ways that we can make U.S. capital markets more efficient and, ensure that they are liquid and deep as they have been. And so I thank you all for having this lively debate. And I think it should be welcomed, and it should be at this level of intensity because it's what will yield the best outcomes for our capital markets. I want a pointed question. I think we're alluding to it, and I just want to kind of point to it, Hitesh. A couple things. The first thing is, how do you differentiate the two outcomes in this tick pilot test, the Group 3 tick pilot test that Doug mentioned, and then your findings as well? So it seems like, did your findings include institutional order flow as you looked at NBBO spreads, or did you just look at retail flow? Like, how did you integrate this kind of what you deemed in your paper as institutional toxic flow and then retail flow?
Yeah, I mean, our analysis was pretty simple. So we looked at, and it's outlined in the paper as far as what our methodology is. And it's basically, we looked at all the trades that happen in exchanges. So it could be institution, it could be any, it could be an HFT, it doesn't matter, right? So every market order that traded on an exchange, what happens to the price after that trade happens? So, if a trade happened at the bid, what happens to the price? If a trade happened at the offer, what happens to the price? And we see that, the prices go down after a trade happens at the bid, which is what you would expect. But we wanted to see what is the magnitude of that price movement. And that's about 60% of bid offer spread. So that's how much, on average, a limit order loses in terms of adverse price movement. Then we took a proxy for retail flow, which is basically the flow that does not happen in exchanges. And we only looked at the flow where the prices are in sub-penny increments, because those are not likely to happen in ATSs. Like, if a print is 39.2385, it's unlikely to happen in ATSs. So we look at those trades to figure out what is the adverse selection when those trades happen, what happens to the prices afterwards. So that's sort of the methodology we used. And, going back to the tick pilot, I don't know, I was not a big fan of this tick pilot. And I don't know if we can establish a relationship that has to do with retail flow moving to the exchanges, because, if you just increase the minimum tick size, by definition, you're going to increase the spread. So I guess
I asked that because in the tick size pilot, it was basically retail and institutional order flow is indistinguishable. And it was showing that if you remove segmentation, what would happen. And it showed a 10% kind of wider spreads in those names. And so I'm just trying to reconcile those views. But I guess the other thing is, so Doug mentioned in his presentation this notion of size improvement. Did your analysis take into consideration size improvement? Because a lot of times, I think one of the things that I think JW referenced earlier was Elad Roisman's comments where, the best X considerations are immediacy, time considerations, information leakage, all these other things that, brokers are thinking about. So did you include size improvement and whether or not the immediacy that a Schwab or other may need for their clients?
Yeah, I just believe that it's just not a fair comparison to compare an exchange versus the retail flow. These are two disconnected markets. people are making markets in exchanges, just like Doug said. He's afraid to make markets in these exchanges because, he gets run over, right? So size is not there and the bid offer spreads are wide because the liquidity that only shows up on exchanges is more toxic. So it's just not the right comparison to compare an exchange versus, what you're providing to retail. Like there'll be a lot of institutions who would be happy to provide liquidity at midpoint, right? If there was an ATS, for example, let's say that, the biggest wholesaler, Citadel, were to, if these guys committed that before they would internalize, they would check the midpoint in one ATS or one exchange, and only retail flow would be accepted in that. There will be a ton of institutions who would show up in that and provide liquidity in that. And that's exactly what doesn't happen, right? Institutions can't trade with retail. Retail limit orders cannot trade with retail. And other market makers cannot trade with retail. And all of this flow goes to 2 or 3 market participants, right? They give them price improvement, and they should. But the question is the price improvement enough? And what will happen if that liquidity shows up in a centralized entity like an exchange or an ATS? I think the price improvement the retail would get would be a lot higher. The size improvement would be a lot higher.
So I guess would that policy model propose that institutional flow, both asset manager flows and others, would they have the same tools as retail? Because I would think you'd want that to be on parity. So asset managers represent, the retail individual as well. And given this committee's mandate, we care a lot about how those institutions would be executing. Are you suggesting then that to be on parity, you get rid of basically dark pools, ATSs, the ability to cross ATSs, and just move everybody on exchange?
No, I think ATS is a great tool for minimized cost for investors, right? So, and there's a big difference. People confuse, people blanket, ATSs and wholesalers in the same category. They're in fact exactly the opposite, right? ATSs are designed so that an investor can trade with another investor, right? That's the biggest form of disintermediation, right? That you have a willing buyer and willing seller, and they want to trade at midpoint. There is zero transaction cost by definition. Right, so that's the biggest form of disintermediation. That should, and then you have exchanges where investors can trade with investors, and investors can trade with intermediaries, but the intermediaries are competing with each other, right? And then you've got the third form, which is the single dealer pools and the wholesalers, where by definition there is zero disintermediation, right? It's only intermediated. So I don't think you can put those in the same category.
All right, Alice has been waiting patiently for quite a while now. Alice, you're going to get the last question, and go ahead. Looking forward to what you have to say.
All right, thank you. I want to thank the panel for their passion here. You're making me feel right at home. At the school where I teach, I've been the debate coach, so this has been, I'm feeling very familiar with this format here. But my question, none of the panelists is a fan of just banning PFOF. But my question is for Stan in particular, when he mentioned that he was not in favor of an outright ban, and I hope I'm characterizing this correctly, Stan, you said that it would that a ban would ignore other perhaps distortionary incentives that either do or could exist, besides PFOF. Or whatever distortions might be created by PFOF. And I just wondered if you could say more about that.
Well, not necessarily, distortionary influences, but I was talking about incentive programs offered by securities exchanges. If you abolish, PFOF, but you don't touch the exchanges incentives, that's going to create, some disparities, in itself, and that's that's one of my arguments here. And also this is connected to Mina's comments about the European regulatory regime. It's not necessarily something being better or worse, but the real question: what should be transplanted? And for instance, I don't see anything else besides a more granular tick-sized regime applicable to everyone else, which is very closely connected to the issue of incentives. For instance, price improvement, and just another quick note. And also, the European regulators had seriously considered banning systematic internalizers or wholesalers, but fortunately, they did not act on that. They seriously thought about removing them from the share trading obligation, and it's I don't think it's the right approach to this wholesale abolition of wholesalers.
Okay, thank you.
Well, I want to thank all of our panelists and our members of the IAC, the commissioners. I think we've had great. We've had 3 hours of best execution today, so that's been fun, and I think it's timely, and I think it will be helpful to the staff and to the commissioners as they continue their deliberations on these issues. I was hoping for a debate, discussion, some agreement, some disagreement, a lot of technical depth, and that's exactly what we got. So I really appreciate everyone for all the help, and we're finishing precisely on time. I do precision panels, Chair Marietta Westberg, precision. So take it away.
You know, I always appreciate staying on time, JW, so I'm very impressed. My thanks again to Doug, Larry, Stan, and Hitesh. Really just a fabulous back and forth discussion, so thank you. We are going to leave Best X behind and move on to our 10B51 panel now. I do just want to recognize that we have had Tracy McNeil, the SEC's ombudsman, with us during the meeting today, so just recognizing another participant. With this, I will give a preliminary thanks to Cambria for arranging this panel. And so let me turn it over to you.
Sure. Thank you so much, Chair Marietta Westberg. So our third panel will consider whether and to what extent reforms are warranted around trading plans established pursuant to Rule 10b-5-1. So as noted earlier, Rule 10b-5-1 was adopted by the SEC roughly 20 years ago to provide corporate insiders an avenue to trade their company's stock without running afoul of insider trading rules. The idea was to untether the knowledge of material non-public information from trading, allowing corporate insiders, who are often paid largely in equity, to liquidate holdings to satisfy personal finance goals, diversify portfolios, buying a house, etc. And over the years, investors, regulators, including past and current SEC commissioners, lawmakers from both sides of the aisle, and even some members of the corporate counsel community have questioned whether the rule needs to be strengthened, maybe some guardrails. Former SEC Commissioner Joseph Grunfest suggested as much in 2013, stating that when the rule was adopted in 2000, the SEC, Commission staff, and market practitioners were concerned that there may be weaknesses in the rule. And, quote, with the accumulation of experience, the Commission would proceed over time to refine the rule so that it would better protect investors without imposing unreasonable burdens on executives and insiders. So today's discussion will focus on what may be working and where the rules could be improved, and offer perspectives on what improvements, if any, the IAC may consider recommending the Commission make to satisfy the Commission's mission to protect investors, support fairness and efficiency in the markets, facilitate capital formation, and of course serve the public interest. With that, I'd like to welcome our esteemed panelists to the meeting. So our first speaker, Daniel Taylor, is Associate Professor at the Wharton School and Director of the Wharton Forensic Analytics Lab. Dan will provide us with a tutorial on Rule 10b-5-1 and discuss recent scholarship identifying red flags that could alert investors to unusual activity within these plans. Next, we'll turn to Keir Gumps, Vice President, Deputy General Counsel, and Deputy Corporate Secretary at Uber Technologies, who will discuss why and how employees utilize the plans, as well as provisions a company may consider to mitigate risk. And finally, Jeff Mahoney, General Counsel for the Council of Institutional Investors, will give us the investor perspective on Rule 10b-5-1, including CII's 2012 rulemaking petition to the SEC calling for modest plan reforms. After each panelist speaks, we'll pause and open up the floor for questions. Per our usual practice, please feel free to indicate in the chat if you'd like to ask the panelist a question, and we'll get you in the queue. And we also plan to have some time at the end for panelist discussion and additional questions. So I want to thank again Dan, Keir, and Jeff, and let's jump in. So Dan, let's start with you with the basics and your research. I think you have some slides for us.
Give me a thumbs up if you can see the slide deck. see the slide deck?
We can. There's like
Excellent.
a box, but I think it's okay. Yes.
Okay. All right. Can we read the text? That's the
We
important
can read
thing.
the text.
Okay. All right. Great. So thanks to the committee for having me present on 10b5-1 plans. And so I'll just briefly say, Cambria asked me to give like a brief tutorial or overview of these plans. And I'm basically going to do it really, really, really quickly insofar as I've only got 20 minutes. So we'll see how much I can cover in 20 minutes, but I'm going to go fast. Okay, so first thing is the mechanics of these 10b5-1 plans. So as you all are no doubt aware, it's illegal to trade on material non-public information. And so that's kind of like the basis of where we start with the history of 10b5-1. Now, the issue that's before us is, well, corporate officers and directors are routinely exposed to non-public information in the normal course of business. And in addition, they're compensated with equity and will develop concentrated equity positions that they may need or want to diversify, right? So you're an executive at the firm, you're going to potentially know the earnings before the earnings are announced. And you may want to, sell just because you have to pay, to send your kids to Wharton or buy a yacht or invest in real estate or what have you. And that was the purpose of 10b5-1 plans, to provide the method for diversifying the equity positions without running afoul of securities laws, right? So they're going to have large blocks of stock that they're going to need to liquidate. So what do these plans look like? So the plans consist of a set of instructions for pre-scheduled trades at regular dates. So here I have Global ePoints 10b5-1 plan that they voluntarily disclosed on Edgar. And you could see at the bottom that it specifies the start date, the end date, and then the limit orders, basically, 200,000 at 5, 200,000 at 6, and so on. And then here's another version from Old Dominion. This is a template, so they have redacted the price and shares that are being sold in the date, but they've just notified investors that a plan was adopted and then given investors sort of a general template. Okay. So we've got these pre-scheduled trades that we're going to agree to at specified amounts and specified prices and specified dates. And the purpose of that is to provide an affirmative defense against allegations that the trades were based on material non-public information. Now, the caveat is that if the plan is not entered into good faith, as Chair Gensler suggested, or it's adopted as a part of a scheme, then, the plan is not valid. And so in practice, it is possible to overcome the affirmative defense, but it is somewhat difficult. The SEC did pierce the plan defense at Countrywide Financial during the last subprime crisis. And basically the way this happens is greater emphasis is placed on the adoption date of the plan rather than the date of the trade. So we're not going to look at, hey, well, did the trade occur before the earnings announcement? We would look at, well, did you adopt the plan right before the earnings announcement? Okay, so just remember, greater focus on the adoption date of the plan. Okay, so here's where things start to get interesting. The plan cannot be modified while in possession of material non-public information. So you can't go back and say, well, I had a limit order at 15, I want to change it to 16. You can do that, but only if you don't have MNPI. If you have MNPI, no modification. But again, as Chair Gensler suggested, the plan can actually be canceled while in possession of MNPI. So you could just cancel the limit order or cancel the plan entirely, even if you have material non-public information. And so here the nuance is that trading on material non-public information is illegal, but not trading on material non-public information is actually legal, right? And this creates something that's known in the academic literature as the free cancellation option. So the user of the 10b5-1 plan has a free option to cancel the plan at any point, regardless of whether the news is good or bad. And so this gives some element of market timing to the user. So what everyone worries about is a circumstance at which at the beginning of the quarter, someone sets up a plan to sell a few days before the earnings announcement. And if the quarter turns out to be a dud, well, the plan is canceled, or excuse me, the plan is allowed to execute and sell the shares before the earnings announcement. But if the quarter's going well and the earnings is going to be reported very high, then the executive might just cancel the plan. and sell after the earnings announcement. So that free cancellation option allows some market timing. And one perspective on that is to say, well, is that really a problem if there's disclosure, right? So if the executive discloses that they're canceling the plan, that would be interpreted as a signal by the market, and that signal would get priced. Well, the issue is that there is no required disclosure, especially around cancellations. So we'll get into the disclosure requirements here. So first, it's important to recognize that corporate insiders of U.S. companies on U.S. exchanges have to disclose their trades on Form 4 within 2 business days. They are not required to disclose whether that trade was pursuant to a 10b5-1 plan on Form 4. Right? Corporate insiders of non-U.S. companies that are listed on U.S. exchanges are not required to disclose any trades by corporate insiders. So you might remember the media kerfuffle and scrutiny of all the trading of executives at Pfizer and Moderna when the vaccine was being developed. Well, Pfizer and Moderna got all the attention, and no one really was talking about AstraZeneca. Well, that's because AstraZeneca, while listed in the U.S., is a non-U.S. company. And so there was no data on the trades of AstraZeneca's executives for the media and for investors to scrutinize. The same thing is particularly acute in sort of Chinese and Hong Kong companies where the SEC and the PCAOB can't inspect the accounting. Those companies also don't provide disclosure of the trades of corporate insiders. All right, so that's something to think about going forward. When I'm doing my talk, I'll be speaking about our first group, U.S. companies listed on U.S. exchanges. Okay, so that's disclosure of trades. What about disclosure of plans? Well, there's no required disclosure. It's kind of simple. No one's required to disclose the adoption of the plan, the modification of the plan, or the cancellation of the plan. Not required to disclose the plans themselves, and not required to even disclose the number of shares that are covered under the plans by key executives. Okay, so it's incredibly opaque information environment when it comes to these 10b5-1 plans. Now, that lack of disclosure is concerning because it prevents proactive risk assessment and policing. Insofar as investors can't see whether the executives entered into one of these contracts to liquidate substantial fraction of their equity, 50%, 90%. Moreover, the SEC's enforcement function cannot actively monitor the adoption, modification, or cancellation of these plan details unless the company voluntarily discloses them or there's some level of document discovery in an investigation. But it's not like there's a database of these plans that regulators or investors have access to, and that firms are required to report their plans in that database. By the same token, they're not required to report the adoption or modification. So all we can observe is the voluntary disclosure piece, which makes risk assessment very difficult. Well, then the natural question is well, okay, there's no disclosure, so then you did an academic study on this, right? Where did you get the data from your academic study? Well, that's very interesting. And so that's going to take us down a rabbit hole that you may not believe at first. But I'm going to present some evidence, and hopefully you'll come out on the other side a little bit in awe. So there is this form, this mysterious Form 144, that executives selling 50,000 or more in restricted stock must report trades on. Form 144 requires the filer to indicate whether the sale was part of a 10b5-1 plan and the adoption and modification date. This provides the source of data on the adoption and modification dates. So if you're a 10b5-1 plan selling restricted shares, you have to file both the 144 and the Form 4. If you're 10b5-1 plan and you're not selling restricted shares, and by restricted shares I mean like founder shares, for example, or control shares. If you're selling instead options or regular shares, then you just have to file Form 4, right? And we've already talked about no 10b5-1 disclosures needed on Form 4. Okay, so now you might be thinking, well, okay, great. So then there is disclosure of the adoption and modification dates for the subset of 10b5-1 plans on Form 144. So just get the Form 144s. Well, that's not as easy. So this is where we get into the rabbit hole. Form 144 can be filed by mail. Those mail filings are not disseminated on Edgar. There are 700,000, more than 700,000 mail-filed Form 144s in the past decade that are missing from Edgar. And many of those are handwritten. So now you're asking, well, where are they? How do you know that? Well, that's a picture of my team inside the, you guessed it, SEC reading room. Guess what's in those file cabinets? The Form 144s. Very easy to verify if anybody's in the building and the SEC reading room is open because of maybe the COVID violations are over or the COVID protocol is over. You can go down and look inside the reading room. What's fascinating about this is the data aggregators will send couriers to the reading room to scan the 144s and then sell the data on the adoption dates and sell the images to their institutional clients. But they're not on Edgar. So here's an example. And, this isn't, it's kind of shocking when you think about it. It really speaks to the information plumbing problem. It's not really a topic you see in the media or whatnot, but it is very, very important. This is the Form 144 that Bob Iger filed in 2018, and you can see that the SEC mail processing stamp on it. Now, Walt Disney has plenty of resources. They have a great legal team. They have great internal controls. And it's 2018, and Bob Iger is filling out this Form 144 by hand and mailing it. Right? Well, what does this have to do with 10b-5? There's your answer. The last page shows the date of plan adoption, in this case, December 18th, 2017, and the date of the trade, August 6th, 2018. Okay, so that's not the only one out there. There's 700,000 of them. Many other Form 144s also filed by hand. So we're going to use those paper filings to conduct that risk assessment. Remember I said earlier, we can't do any risk assessment because we don't have any data. Well, laboriously, we're going to use scanned images of paper filings, digitized, to actually get that data and do large-scale data analysis of plan adoptions. And in total, we're going to study over 20,000 10b5-1 plan adoptions and associated trades. And I want to thank the Washington service who helped us with a lot of this, digitizing. Okay, so what are we going to do? Well, what we're going to do is we're going to study the plan adoption date and then the date of the trade relative to the adoption date. And this is what's known as the cooling off period. So a cooling off period basically is when you adopt a plan, how many days is it before the plan is allowed to execute its first trade? So here what we see is that if the plan allows the trade within 30 or 60 days, the price after the trade on average declines. Okay, so that means that the CEOs or the executive sale avoided losses and material losses. But if the cooling off period was more than 60 days, we don't see any loss avoidance. Now this is on average, okay, so there are going to be outliers on both groups. But the point here is that there seems to be this hard cutoff at 60 days where you see loss avoidance for cooling off periods less than 60 days and no loss avoidance for cooling off periods more than 60 days. Digging into why that's the case, it turns out that there are plans, about 38% of them, that are actually adopted inside the same quarter, let's say in quarter 4 of 2020, that also place a trade before that quarter's earnings announcement. So adopt a plan in Q4 2020, place a trade before the earnings announcement. And here we see all of the trades placed before the earnings announcement in the quarter they're adopted avoid material losses. But if the plan is adopted before the earnings announcement and the trade occurs after the earnings announcement, there's no loss avoidance. So that suggests that our executives have, more than a 30-day knowledge of material non-public information because they may be aware of the earnings more than 30 days in advance. Okay. Some evidence-based recommendations. I think it's really, really important that we do evidence-based policymaking. All right. And when we do evidence-based policymaking, we need to consider the various costs and benefits. On the one hand, we have to balance the needs of senior executives for liquidity and diversification. Right? That was the purpose of 10b5-1 in the first place. We also have to consider the value of giving an executive an affirmative defense against insider trading charges. Okay, that's a valuable legal shield. Okay, it shouldn't be free. The shield's valuable. We need to confer it carefully. We can't just give it away willy-nilly. And then finally, we need to balance investors' need for information with respect to executives' equity trades. So what I've done here, co-authors and I have compiled downloads from SEC's Edgar from 2003 to 2017. This is available. This data is publicly available. And what we find is that there have been 4 billion downloads of Form 4s. That has the information on the trades. At the same time, that is more than the total downloads of all 8Ks, 10Qs, and 10Ks. So FASB, accounting, management discussion analysis, MD&A, all of that good stuff in the 10K, the 10Q, and the 8K, there's more demand for information on executives' trade than there is for all of that information combined. Okay, so this is very, very high on, let's call it the information pecking order for investors' needs. Okay, so now that we've got sort of these scales and how we want to weigh these various levers, let's think about some recommendations. Well, first is, can we get all companies on U.S. exchanges, including our foreign issuers, to disclose the trades of officers and directors? This is to make sure that all of the firms on U.S. exchanges are on a level playing field. So this is very similar to the Holding Foreign Companies Accountable Act, to make sure that all of our companies on U.S. exchanges play by the same rules. The second, mandatory electroning of Form 144s, posting those on Edgar. Under prior Chair Clayton, the SEC proposed amendments to Rule 144 that would do that. Those have not yet been adopted, and I would hope that they would be. And then modifications to Form 4 to require a checkbox for trades that are made pursuant to a 10b5-1 plan, and disclosure of adoption and modification dates for any 10b5-1 trades on Form 4. So you'd take a Form 4. Right now, you'd see the trade, the price, the shares, the date of the trade. There'd be a little checkbox that would say, is this a 10b5-1 trade, yes or no? And if it is a 10b5-1 trade, what was the date that the plan was adopted? Now, we do need to carefully consider the burden to filers. But it's important to think here that if the trade was made through a plan, then the plan details are going to be readily available at the time of the trade because the trade was automated. So there's not that much burden here to our issuers from these relatively straightforward modifications to Form 4. The other point that I want to point out is that the adoption date is material. So you might think, oh, it's just an adoption date. How material could that be? But remember, in our analysis, we found that the trade date relative to the adoption date generates significantly different returns, all right, or significantly different loss avoidance. So our analysis looked at the adoption date, and we found differences in return patterns, and that would lead to differences in valuation, suggesting evidence of materiality. All right, what about the plans themselves? So that was the disclosure of trades. What about the disclosure of plans? Well, the disclosure of the number of shares covered by 10b5-1 for named executives officers in the annual proxy statement. Why is this important? Prior to voting on a compensation package, you might want to know whether the executive signed a plan to liquidate a substantial fraction of his existing equity. So if the CEO has executed a plan to sell 90% of his equity, do you really want to vote on a compensation package to give him or her more equity? And this is not an uncommon set of circumstances. Both the Under Armour CEO and the former Under Armour CEO and former CBS CEO used these plans to liquidate, over 100 million and over 150 million in total. Now, there's nothing wrong or illicit about that at all. But shareholders might wanted to have known about those plans at the time that they were voting on the compensation. And the plan administrator will have that information for C-suite executives. Okay. Next, disclose the adoption of the plan for our top executives, our Section 16 insiders, on the Form 8K, along with any subsequent modifications or cancellations. So some companies, as I mentioned at the outset, already voluntarily disclose the plan on the 8K, and they redact or omit sensitive information. We're suggesting making that disclosure, my co-authors and I are suggesting making that disclosure mandatory as opposed to voluntary. Now, it's important to note here that if the plan is never modified or canceled, this would only require a single filing at the time of the adoption. If the executive wants to modify or cancel the plan, then that would require additional 8Ks and additional disclosures of every modification or cancellation. So that intentionally creates a greater disclosure burden on those who are frequently modifying and canceling. But that's exactly who I think we would be particularly concerned about. If you're frequently modifying or frequently canceling, shareholders are going to have greater demand for information. They're going to know why you're doing this so frequently. Now, this is sort of a, I don't want to say a half measure, but it's kind of a half measure. The alternative is just to outright ban modification and cancellation of these plans, but we didn't see that as feasible given the executive's need to be able to, sell their shares. All right. And finally, we're going to suggest that the commission adopt Chair Clayton's recommendation of a 4 to 6 month cooling off period. Now, why the 4 to 6 month cooling off period? Well, we need to ensure that the plan cannot be adopted and trade prior to the same quarter's earnings announcement. Remember the evidence. The evidence suggested that the loss avoidance was greatest when the plan's adopted in the quarter and it also trades before that quarter's earnings announcement. A 4 month cooling off period ensures that when the plan is adopted, the trade cannot occur in that same quarter. And that's what we saw in terms of where the loss avoidance was coming from. So adopting that cooling off period would have pushed the trade into the next quarter. Yes, that will be inconvenient for executives, but it can be viewed in some sense as the price of the affirmative defense legal shield. And so this is quite important here. It is going to be inconvenient, but by the same token, there are no free options. In order to get the affirmative defense, there do need to be some basic requirements designed to minimize the use of MNPI. Now, if an unexpected bill, say for Wharton tuition, comes due now, and you can't wait 4 months to sell, you can always place a regular market order to sell and to raise money. Thank you very much for listening and for your attention. The sources for a lot of the data are a lot of my prior work, and I will make the slide deck available. Thank you.
Great, thank you, Dan. So I'm going to pause and see if we have any questions from the chair or any of the commissioners who may be on the line. Okay. All right, hearing none. Please feel free to put a note in the chat if you'd like to ask a question. Otherwise, we can continue with the presentations. I actually think we're doing really well on time. All right, excellent. Thank you, Dan. That was very thorough. So really appreciate the presentation. All right, so next I'm going to flip it over to Keir, who is going to give us the corporate perspective. So we heard about, what these plans are, maybe some of the challenges within these plans or execution of these plans. So, why would an employee set up a 10b5-1 plan?
Great. Thank you. And let me just start by saying thank you for the invitation. I'm very glad to be with you all. And I spend a lot of time in this area, so grateful to be part of the discussion. The thing about 10b5-1 plans that people should remember, the number one reason that people use 10b5-1 plans is not necessarily liquidity. It's not because people want to game the system. The number one reason is that they want clarity. And if you can kind of take a time machine back before the rule was adopted, you had a scenario where insiders and companies wanted to engage in trades, whether it be buying or selling. And there was always this question about what were the circumstances when they may or may not have material non-public information, and what were the circumstances where trades that they may have been engaging in could create exposure or liability for them. And so the most valuable thing about Rule 10b5-1, more than anything else we're going to talk about today, is that it provides clarity for both companies and insiders when they want to engage in trades, because the liquidity is there. They can go out and sell stock at any time that they don't have MNPI, right? They don't necessarily have to use a plan. And so in some ways, the creation of Rule 10b5-1 providing that clarity made it a lot more, provided a lot more assurance for both companies and their insiders and for the investor community about the trades being engaged in by the people adopting those plans. And so that's the first thing. And I'll frame it for you this way. We are all on the same page. No one wants to see insider trading happen. And I guarantee no one wants to be accused of insider trading. And that's something I heard constantly when I was in private practice, something I certainly see when I'm at Uber. The second thing is, because people want clarity and because they don't want to engage in insider trading, what 10b5-1 plans really do is they help companies and insiders mitigate risk. So, Cambria, one of the questions you'd asked me leading into this is why do companies encourage insiders to adopt 10b5-1 plans? And that's because every company or most companies, if you look at their insider trading policies, number one, they discourage insider trading. They tell insiders, employees and the executive officers how to avoid insider trading. And then they have a whole list of policies and procedures intended to curb or mitigate the risk of someone engaging in insider trading. And 10b5-1 is a really great way to do it. And the last thing I'll just note in terms of why companies and insiders do it, it's because it gives companies confidence in trades. It gives insiders confidence in the trades that they're engaging in, and then they increase investor confidence and can facilitate more orderly sales.
Okay, great. So which employees, are not just eligible for the plans, but, you see a difference in who's using them more often. So who's using them?
Yeah, it's a great question. Well, the first thing is it depends on the company, and it largely depends on an individual employee's circumstances. But if we're talking generalizing, in most cases, it's executive officers and directors. Now, Uber is an exception. We have, because of the data sharing that we have at the company, literally every single person at the company is subject to our blackout periods, right? So a lot of companies, the blackout period is limited to directors and officers, and therefore 10b5-1 plans are most often limited to those people. But for companies like Uber and other technology companies where there's a lot more data that's shared within the company, what companies do is they say, we're not going to take a risk. We're going to subject everybody to the blackout periods and window period cycle. And that also means that to the extent that you want to have the same kind of confidence that executive officers and directors can have by adopting these plans, you as a rank and file engineer, for example, can adopt a 10b5-1 plan because we all have that shared goal of mitigating risk and eliminating insider trading if possible.
Mm-hmm. Great, and I know you also have a role at the Society for Corporate Governance as well, and there have been some surveys done by the Society. Can you give us any data on that? Yeah.
Absolutely, perfect setup. Thank you, Cambria. So yeah, there's a survey that the Society is going to be publishing soon. So these are some excerpts from that. First thing, there were a number of questions. I'm not going to go through all, but in terms of usage and who was using these plans. First, less than 5% of the companies that participated in that survey indicated that board members were required to sell pursuant to 10b5-1 plans. And similarly, less than 15% indicated that the C-suite was required to sell using those plans. However, the vast majority say that their executive officers and directors are strongly encouraged, and that's, by the way, the same language that you'll see in our insider trading policy. And then most companies don't limit the ability to use 10b5-1 plans. And I say most, there are of course exceptions, but for the most part, if you are an employee and you're worried about having access to MNPI, again, the safe way to manage that risk is to use a 10b5-1 plan, whether you're buying or selling that company stock.
Great, thank you. And you talked a little bit about some of the common uses of the plans. Any additional considerations you'd like to share?
Yeah, absolutely. So the first thing just to share, and this was a little bit surprising for me. I'd been at a law firm for 13 years before I came to Uber, and before that I was at the SEC. And I didn't really understand how exposed many employees are to equity. And by that, I mean, particularly at technology companies, you have many employees, but certainly folks who were there in the early years, where the substantial majority of their compensation is equity. And when I say substantial majority, think not 50%, like 60, 70, 80% of their overall investments and their income from that company is in the form of equity. And that creates a real challenge when you think about normal expenditures that people have, particularly if you're living in expensive places like the Bay Area or New York. In Dan's slides, he had the example of Wharton tuition, and that is by all means expensive. But a lot of the questions that I've gotten since I've been at Uber, or the questions that I got when I was at Covington, related to much more mundane circumstances. Someone needs to pay a school bill. They have a big tax liability coming up, and they need to have the ability to access the value represented by those shares. And so in many instances, what my advice has always been, well, if you're someone who regularly has access to material non-public information, whether it's because you're an officer or a director, or let's say you're in corporate development, maybe you're an IT person who facilitates the protection of financial information, in any of those circumstances, it's better for you to adopt the 10b5-1 plan as opposed to just chancing it, waiting it, seeing if there's going to be a window, and then selling your stock then. So that's one important thing. And the tax one, by the way, is major. As a company that just finished doing our IPO, one of the things that I had not anticipated was the way that as companies, you can't withhold the maximum amount that someone may owe on their equity. And so what ends up happening is a lot of executives and employees at newly public companies need to liquidate some of those equity holdings in order to just pay things like their taxes. And so that's the first thing. Second thing is regularity. So, if you are an employee of a newly public company, for example, and you've been receiving compensation mostly in equity, and now you're a public company, well, you should consider that equity as part of your regular compensation. And if it's all locked up because you're subject to blackout periods or special blackout periods, it's obviously difficult to access that. So what a lot of employees will do is they'll create these Rule 10b5-1 plans and to establish a regular, predictable set of cash flows coming to them so that they can have that cash available for their routine needs. And again, that is something that's a concentrated risk for tech companies, but it exists across the board. And then the last thing, which is really important, is the mitigating risk. And I just can't say this enough. We had a discussion with a bunch of engineers who had been at other companies, and they were asking about 10b5-1 plans. And the head of this group started off by saying, hey, guys, I want to explain why we're here. We're here because I was at another company where we didn't have as robust a process as we do at Uber, and people got accused of insider trading, and it was horrible. It ruined people's careers. And so I strongly encourage you to adopt a plan. And that is, at least in my mind, the third most important reason that common use for these plans.
So, Kira, you kind of mentioned a little bit hinted at some of Uber's policies. Can you talk through those policies, and then also why do you have them?
Yeah, absolutely. And I just want to note, although I will not agree with everything that Dan said, we are aligned on many things, which is first, we do have disclosure. So we identify scheduled trades of that are made pursuant to existing 10b5-1 plans on our Form 4s. And we do this because we think it gives markets reassurance regarding why the trades were happening. And hopefully they made clear to the world, but certainly to our investors, that the insiders at issue aren't directing specific trades. So that's the first thing. Second thing is, as I mentioned a moment ago, our insider trading policy doesn't require that anyone enter into a 10b5-1 plan, but we do strongly encourage our executive leadership team, our board, and those that are at higher risk and for special and often prolonged blackouts to enter into Rule 10b5-1 plans. And then our window, we have a requirement that you can only enter into a Rule 10b5-1 plan during an open trading window, again, provided that you don't have MNPI and that you're not subject to a special blackout. And just one important note through all of this, you have to be doing it in good faith. So the idea of kind of this cancellation option, it's a great idea, theoretically, academically. I question whether it can actually happen if you're entering into a plan in good faith. But that's for our discussion later. Duration of the plan. Any plan at Uber has to have a duration of at least 3 months. All trades are subject to a cooling off period. We have 30 days, which, by the way, talking about surveys, that is the most common. Looking at a 2015 survey that the Society did along with another organization, more than 43% of the companies surveyed included a 30-day cooling off period. I think that is kind of the middle of the fairway, at least from what people are doing from a benchmarking perspective. Trades outside the plan, our policy strongly discourages employees from transacting in our securities outside of the plan. And then last two things, pre-clearance requirement. If you have a 10b5-1 plan, you have to pre-clear any other trade. And then if you're officer director, you're generally on a pre-clearance no matter what. Last but not least, modification. So for us, and Dan's point is a good one. I mean, if you're following the rule, when you modify the plan, what's really happening is you're canceling the old plan and adopting a new one. And if you're adopting the new one, all the same requirements that applied in the beginning apply then, meaning you can't have MPI and you have to be doing it in good faith, right? And so our policy takes that a step further and says plans can be modified once during a rolling 12-month period and only during an open trading window, so long as you are not in possession of MNPI. And then modifications are subject to the same cooling off period as a new plan, i.e. 30 days. And then the last thing as part of modifications is the idea of cancellations, which is plans can be terminated early, but if you elect to do so, they have to wait 6 months. And can I just say one word about cancellations, because I know this will be a subject of discussion. In most, first of all, from an insider trading perspective, a cancellation is actually not an event, because what an insider trading is about is someone on one side of the trade having more information than the other person on the other side of the trade. If there isn't a trade, then there isn't actually an insider trading violation. I understand policy-wise the commission may choose to adopt a rule regarding cancellations. That's perfectly fine, but I want to be very clear that a cancellation is not actually an insider trading event. So, and that's important. But for us, what we say is if you want to terminate your plan, you have to wait at least 6 months before entering into a new 10b5-1 plan. And we do that because we want to be sure that no one can come back and question whether it was in good faith, frequent modifications, all those things that we're all worried about in common. And those are kind of the broad brush outlines for our policies.
And Kier, what about overlapping plans?
Oh, yes. So we don't allow thank you. Sorry, Cambria. You knew my plan better than me. We do not allow overlapping plans.
Okay. And why not?
It's for a lot of these are more optical things rather than actual considerations about whether someone's engaging in insider trading. But when you look at the very few number of cases that there have been where Rule 10b5-1 has been cited, one of the things that the staff has talked about is this idea of overlapping plans, calling into question the good faith of the person who entered into those plans. And so, as a matter of policy, we just don't allow you to have overlapping plans.
Okay. Well, maybe before we get into your thoughts on recommendations, what are some of the implementation challenges that you guys face or any of your corporate peers?
Yeah, this is the easy one. And the thing I want people to remember, and look, at the end of the day, we're all on the same page. No one wants insider trading to happen. It's bad for everyone. It's bad for the markets. It's bad for the people on the other side of the trades, the insiders. It's bad, right? But we also have to keep in mind that these are people. And these are people where a lot of their compensation, their personal wealth, they may have personal situations happening. It's tied up in this stock. And so whatever happens, and as we implement these policies, we always have to keep that in mind. And it's tough. I would say of all of the things when I was in private practice and my time here, you get a lot of very challenging questions. Now, the good thing is we're all on the same page. If you say to somebody, you can't do that because that's insider trading, that usually ends the conversation. But the fact is that is what makes it hard, because you have this inclination as a human being to want to help someone, pay this tuition, to pay school bills, to pay whatever, their tax bill. But at the same time, these rules are there for a reason. And that is, in my mind, the most challenging implementation challenge.
Great. So we heard from Dan some of his recommendations for reform. I know you have some thoughts as well. So what would you recommend to the IAC?
I think the most important thing, number one, the policies that I just described, and a lot of what Dan described, you're going to see reflected in the vast majority of insider trading policies. So I do think there's broad alignment there. I think I really have 2 points for the IAC to think about. The first is, any rulemaking on this topic should be data-driven. What do the facts show? When you investigate, look at the trading practices, what do you see? Is the rule achieving its goal? Because remember, the goal of this rule, it isn't liquidity per se, it's to allow people to comply with insider trading law. That is the overarching goal. And whatever rulemaking the IAC recommends to the SEC, whatever the SEC does, they shouldn't discourage the use of plans, because big picture, plans are better for the markets, they're better for individual, better for companies. And also important to remember, there have been very few insider trading cases involving Rule 10b5-1 plans. So that's the first thing. Second thing is, think about the low-hanging fruit. There, in my mind at least, there is a ton of low-hanging fruit in the form of best practices that can give the SEC what it needs to enforce the rules without creating unnecessary churn or cost. And I think if you kind of start with those two things, being data-driven and starting with the low-hanging fruit, I think you get a lot of consensus in any rulemaking.
Great, thank you, Keir. So I'm going to pause here. We're going to open it up for questions for Keir or Dan. And I'll start with any of the commissioners or the chair if they're on the line. I'd like to ask any questions. Okay, hearing none, I am going to go to Ted, who has a question for Dan. Ted, we can't hear you.
Okay. Well, thanks very much, Cambry. And thanks to the panelists, too. It's very enlightening. I had the question for Dan was associated with the impact of non-disclosure on private investors. Have you done a study on that at all?
You mean non-disclosure by, private investors who are not officers and directors?
Yes, I'm sorry.
So that is what is somewhat interesting about the Form 144 setting, because the Section 16 Form 4 is only required by corporate officers, directors, and 10% owners or greater. But the Form 144 is required by anyone that has restricted control shares. So, for example, before the company goes IPO, maybe the venture capitalist or the private equity firm has less than 10% ownership of the firm. So they wouldn't qualify for Form 4, but they would still have to file a Form 144 on paper. So there is evidence of these, what you would say, these private individuals trading, through this 144 paper filing. But there hasn't been anything done in terms of comparing their trading to that of the, let's call it the top, the guys or girls at the top at the officers and directors suite.
Keir, do you have any comments on that? I mean, from the corporate perspective, is that also a bit of a challenge for you?
Well, so we talked about this. So look, there's a letter from the society on this topic. So I don't want to contradict that, but I will say this, even from the inside, the fact that Form 144s are filed electronically, one, is just bizarre. I just think that is a bizarre thing in 2021 that we're still making paper filings, point one. Point two, there's a lot of information that you don't get. So, we have, even as an insider, right, we don't always get the 144s when they're supposed to be provided to us. And you got to chase people down. Did you do that trade? Can you provide verification if it's not like an officer or director? And so I do think there is a little bit of a gap there. There are differing opinions within the corporate community, so let me just note that. But I think it is really bizarre that in 2021 there's anything meaningful that is filed in paper form and not electronic.
Thanks, Keir.
You agree?
Heidi.
You agree?
Go ahead.
Dan, do you agree?
Yes. No. Absolutely. It's mind. The two things that I found to be mind-boggling was that we had paper filings in 2020 that they're stored in this. It's not really the basement, but effectively the basement of the SEC reading room. And some people would say, well, they're not that valuable. But the evidence contradicts that, because there are private data collectors sending couriers to scan those things and then sell them. So you can find those forms on a Refinitiv Icon terminal, but you can't find them on Edgar. And so presumably they're selling those because there's some value associated with them.
That would be a recommendation that the two of you all will make to the IAC, right? To provide that. You done?
Yeah, I just think it's where they're not filed. I just have to agree. I don't understand. I will say on 144, Dan's research was very helpful in showing that there's high demand for the Form 4s that are filed. But I do wonder, and I don't know whether it's like correlation or causation, how much of that is from like the 16B bar, where for a lot of, if you're, a firm that focuses on 16B violations, what they do is they look at the Form 4s that are filed and they match trays to look for purchase and a sale within 6 months. And so I just don't, I don't know, Dan, maybe that's something you looked at, but that's just one thing I think should be looked at as we're thinking about how important the Form 4 information is. But on Form 144, I don't get it. I'll just say.
So Heidi, I'm going to turn to you.
Thank you.
Thank you very much, and thank you, gentlemen, for your remarks. Very interesting and helpful. I wanted to ask you about the cooling off period. And so, Dan, you showed some very, very interesting data about sort of what is actually happening with the stock price after the trades. And the time frame that was most telling was a 60-day period. Here, you mentioned that 30 days is the Uber cooling off period, and it is, I believe, most typical within the corporate community that 30 days is used. So would you here feel that extending that time based on the data that Dan has showed would make sense? And importantly, based on the community that you were in conversation with, would that be disruptive to them, or do you feel that that would be problematic in any way? I hear what you say about good faith, but the data is the data, right?
Yeah, I think two things about the data. So first, in terms of, and I should have given the typical disclaimer, I'll speak for myself, not for every other company, but look, I think people choose 30 days because there's a degree of comfort that if it was the next day, that would be problematic, and that if it was 6 months, it might be too long. Now, where in between that, whether it's 2 months, 3 months, 4 months, I think we can debate that, honestly. And I think that that's something, if the SEC were to explore that, what I'd want to see is, again, this correlation or causation. Like, is there, because Dan's evidence, I do think, is fairly clear. There's something there, but is that enough to change the practice? I'll just say this much, though. If you sign up for a plan today and you have MNPI, you just signed an invalid plan, and your trade is not protected. And I think that should give a lot of comfort. But the question is that enough from a regulatory perspective? But I do think you can't forget the good faith MNPI requirements of the rule that already exists.
I of course, that's true. But I do think it's difficult to enforce an insider trading case based on a trade that was covered by a plan by somebody who should not have been entering a plan at that time. So from an enforcement standpoint, I just think it's just asking a lot. But anyway, I appreciate your remarks, and I think one of the things that the committee is going to be thinking about is, if there's a mandatory cooling off period, what's going to be. So thank you very much.
Yeah, and I'm not sure you're going to have people as violently opposed to that as you might with other things. I will say this, though. If the concern is about enforcement and giving the SEC the tools, I question whether the focus should not be on what's filed with the staff, what's provided to them. And I do think, like, filing the plan itself, we didn't get into that, but I'm not sure that that's the right approach. But giving them to the staff, finding some way that the SEC can enforce or its duties with respect to insider trading would be really, I think, interesting to explore.
Mm-hmm. Great, thank you, Keir. So, Brian, I'm going to turn it over to you, and then we'll go to Jeff for his comments.
Okay, thank you. A couple questions, or I think it's all kind of the same topic for Keir again. So first, just a quick point on the use of 30 days and that debate that you referenced as to what's the right period. I mean, I just would remind everybody on the committee that publicly traded companies generally report earnings roughly, 30 to 45 days after the end of the quarter. So it is very common for a corporate executive to know how the quarter went within more than 30 days before public investors would have that knowledge. So 30 days does feel
that would be an invalid plan, but that would be, Brian, like, important. That would be so for us, for example, you can only adopt a plan during the window. The window is tied to when we think you have information about the quarter.
Do you have a sense of every company follows that kind of an approach at this point?
I can't speak for everyone. Dan has actually looked at this, so I defer to people with actual knowledge. But I will say, experientially, yes. Like, you tie your insider, your blackout window to when you think that information is developed enough that people would have MNPI.
I do have another question, but I'll let Dan jump in. Dan, do you see evidence of that that's pretty common?
So a couple of things. First, there's a 2020 Deloitte survey. I can send it to Adam and to Cambria, where they asked, do you allow 10b5-1 plan adoption inside a restricted trade window? And 10% of companies answered yes. So there is, I don't know if 10% is a large number or not, but there are companies that do allow plan adoption inside the window. There are also, and this is going to be mind-boggling, but I can say this with absolute certainty, although I'm not going to, can't speak to the specific settings. There are companies listed on NYSE and NASDAQ that do not have restricted trade windows around earnings announcements. So it's important to realize that the exchange listing requirements require insider trading policies, but they don't specify what actually has to be inside those insider trading policies. So we thought really hard about it when we thought about the recommendations. What we want to avoid is a circumstance, Brian, kind of like what you described, where the executive adopts the plan in the quarter, and then that plan executes the trade before the earnings announcement. So one would say, well, okay, you could do kind of like what Uber seems to be doing and say, well, okay, don't adopt this thing inside the earnings, inside the earnings blackout window. Maybe the earnings blackout window for Uber may extend, before the fiscal quarter end, right? Maybe 2 weeks or so before the fiscal quarter end. But then there are other companies that don't have such robust blackout periods. And then companies don't have any robust blackout periods. And then where things get really weird, and I've done a study on this for the fourth quarter, is where the earnings announcement gets pushed back because, let's say, there's some audit failures or there's something coming down the pipeline in terms of a restatement. And so if you tie it very narrowly to the restricted trade window, that can vary by firm in terms of how arduous the restriction is, as opposed to just saying, kind of like flatly, 4-month cooling off period or 3-month cooling off period.
Okay.
Something to that extent. So that's where we came up with that recommendation. But the genesis or the thought was to get the first trade to execute after that quarter's earnings announcement.
Okay, and that leads me to my second question. So whether it was Dan's recommendations or even some of the comments by Chairman Gensler at the beginning of this meeting, where we talked about, a little bit longer, a required cooling off period, not having multiple plans, and then some improvement in the disclosure requirements. Go back to you, Pierre. So it sounds like, generally speaking, at least some kind of a cooling off period and the prohibition of multiple plans is already consistent with what you're doing at Uber, correct?
Yeah, that's right. And I think, honestly, that's consistent with most plan policy. I mean, look, no one is asking for more rules, right? No one ever does. But if the question is that consistent with best practice in the market? I'd say yeah.
Okay, so in that sense, the SEC, the IAC shouldn't view codifying those rules as a massive disruption of the majority of the way companies are operating. It sounds like that's in the mainstream for the most part. But it leads me to my last question, which is the specific question of, is there anything that you are hearing being discussed, whether it's a recommendation from Dan or the SEC staff or us, that you are concerned about in terms of finding that right balance between these competing goals?
Kira, if you can give the 30-second version so we can get to Jeff.
Yeah, disclosure. I think disclosure is really the toughest piece of all of this, like how much disclosure is appropriate. Filing the plan itself, it's like the last panel where they're talking about front running as a risk, but some disclosure. And the question is, where's that line?
Thanks, Kira. All right, so we are going to move over to Jeff, who is going to tell us about the investor perspective and CII's work on this. So Jeff, the floor is yours.
Well, I want to thank the committee for inviting me to participate on this panel. I want to especially thank Cambria for identifying this important issue and for getting us organized. I'm appearing here today on behalf of the Council of Institutional Investors. CI is a nonprofit, nonpartisan association whose core membership includes U.S. asset owners with assets under management approximately $4 trillion. Our associate members include a range of asset managers with more than $35 trillion in assets. So my assigned task is to address 5 questions that Cambria provided to me in less than 12 minutes. So let's get started. So the first question is why investors are concerned about Rule 10b-5 plans. And my answer to that goes back to 2008. when CII adopted a membership-approved policy about Rule 10b-5 plans. That policy was a response to member concerns about a number of reported practices that appeared to be inconsistent with the intent of the rule. And those practices included sales of stock soon after plan adoption, frequent amendments and terminations of existing plans, and just the overall lack of transparency of the plans, including the lack of disclosure of their adoption, amendments, and terminations. So we believed back in 2008, and we still believe to this day, that those types of practices may indicate that the plans were not adopted in good faith, or that material non-public information was a factor in the decision to trade through a 10b5-1 plan. When you go back to the rulemaking in the year 2000, the stated benefit of Rule 10b5-1 was to, quote, increase investor confidence in the integrity and fairness of the market, unquote. So we generally believe that public confidence that our securities markets are fair to all participants serves the needs of companies and investors. And we believe that when insiders transact in their own company stock through a 10b5 plan using practices that appear to be inconsistent with the spirit of the rule, we agree that public confidence in both corporate management teams and the capital markets more generally can be eroded. The second question was, what prompted CII's 2012 rulemaking petition to the SEC to reform Rule 10b5-1? So at least two sources of new information came to my attention in 2012 that led to that rulemaking petition. The first was a November article by the Wall Street Journal that reported on its study and analysis of executives who had traded their own company stock since 2004. The study found that over 1,000 executives recorded average stock gains of 10% or greater, or avoided 10% or greater losses within a week after their trades, which was close to double the gain or loss avoidance of other shareholders. The journal article went on to identify a number of shortcomings to Rule 10b5-1 plan practices and provided examples of those shortcomings and referenced some related empirical research. So some of the practices discussed in that article were that they discussed how insiders trading plans may initially have a target price for stock sales that may be too high, and the executive may just simply make an amendment to the plan to lower the target price and then immediately sell shares without a waiting period. Journal also described how executives can cancel a plan at any time when the cancellation of the plan's prescribed trades benefits them financially. Finally, the journal article described how companies and executives don't have to file the plans with any federal agency, and as a result, the plans aren't readily available for regulators, investors, or anyone to examine. The second source of new information that prompted our petition were the conversations I had with the Wall Street Journal reporters, with the academics that conducted research in this area, and with some practicing attorneys who advise clients on 10b5-1 plans. Results of those conversations led me to conclude that the 10b5-1 plan practices that our members raised some concerns about in 2008, that those practices were still flourishing 4 years later in 2012. So my third question is, what is CI's current position on 10b5-1 plans? My answer is that in September 2019, CII updated its executive compensation policies to streamline its voice on pay design. As part of that project, CII decided to address the related issue of insider stock sales through a separate statement, in part to elevate and expand upon our concerns related to the manner and timing of such sales. So, adopted in March 2020, our new membership-approved statement on stock sales by insiders reflects CII's current position on plans. That statement describes a number of best practices for plans. We state that plans should be publicly disclosed, that plans should have a cooling off period of at least 3 months following adoption, that the plan should be ineligible for substantive modification, that insiders should not be a party to multiple active plans, nor should insiders be able to frequently cancel or adopt new plans. My assigned question number 4 is to discuss some of the previous regulatory legislative actions in this area. My written remarks, and I'll make publicly available, detail a number of the recent legislative and regulatory activities related to Rule 10b5-1. Let me just highlight 4 of them. First, both in the last Congress and in the current Congress, the House of Representatives passed a bill to require the SEC to study and then adopt rules to reform 10b5 plans. While the bill did not pass the Senate in the last Congress, and it may not pass the Senate in this Congress, I still think it's significant that when the bill was voted on in the last Congress, the recorded vote was 413 for and only 3 against. When the bill was voted on this Congress, the vote was passed under suspension of the rules, and so there was no recorded opposition to reforming these plans. Second, I think it's significant that in November of 2020, in testimony before the Senate Banking Committee, SEC Chair Jay Clayton informally proposed amending the plan, Rule 10b5-1, to require a minimum cooling off period of 4 to 6 months between plan adoption and the first plan trade. Also, in March of this year, there's an opinion piece that I recommend everyone read. It's published in Bloomberg, co-authored by SEC Commissioner Carolyn Crenshaw and my fellow panelist, Professor Taylor. I think that opinion piece does a good job of describing the issue, and I think provides some compelling evidence-based approach to reforming the rule. And finally, and most recently, the comments that SEC Chair Gensler made at the CFO Network Summit and in connection with this meeting, where he shared his thoughts on how the SEC might freshen up the rule, including addressing concerns about the lack of required cooling off period, the lack of limitations on when plans can be canceled, or on the number of plans that an insider can adopt, and the lack of mandatory disclosure requirements regarding the plans, their adoption, modification, and term. So finally, my 5th and final question is, what should the IAC recommend to the SEC to strengthen the rule? So my recommendations track a lot of what Professor Taylor said earlier, but I believe the recommendations should have a 2-pronged approach. The first prong should be on disclosure, public disclosure of the plans, related transactions. As Dan mentioned, one way to address at least part of this is the SEC could issue a final rule in connection with the 2020 proposal on the Rule 144 holding period, Rule 144 filings, to require that the Forms 4 and 5 indicate via mandatory checkbox whether the reported transactions were made pursuant to 10b5-1c. They could also provide disclosure of the adoption date of the respected plan on those forms. And finally, I think everyone probably could agree that the Form 144 should be electronically filed so there's broader access. Other potential disclosure proposals would be a rule requiring that the compensation discussion and analysis section of the proxy statement include information on the number of shares covered under the Rule 10b5-1 plans of the named executive officers. And finally, consistent with Professor Taylor, we think the SEC should consider requiring that the plans be filed on Form 8K, including disclosure of the adoption, modification, or cancellation of those plans. The second prong is to reform the plans by proposing some additional rules, providing some conditions in order to qualify for the affirmative defense under the rule that we've been discussing. And Chair Gensler talked about some of these as well. So some additional conditions might be at least a 3-month or 4-month cooling off period between plan adoption and the initial trading under the plan. And then, as Chair Gensler has pointed out, maybe some limitations on insiders having multiple or overlapping Rule 10b5-1 plans or some disclosure about when and how the plans might be canceled, putting some limitations on when and how. So that concludes my prepared remarks. I think I was within the 12 minutes, so I want to again thank the IAC for inviting me to participate, and I look forward to any questions. Cambria?
Great, thank you, Jeff. So again, I'm going to pause and see if there are any commissioners on or the chair would like to ask any questions. Okay. Hearing none, opening it up to IAC members. Again, please feel free to put a note in the chat if you'd like to ask a question. So I actually have a question for the panel. And Jeff, maybe I'll start with you, or anyone jump in. So the chair in his remarks earlier today mentioned the connection between 10b5-1 plans and share buybacks. So I thought this was kind of interesting. Jeff, Dan, Keir, do you have any thoughts on that or anything that we might consider with respect to share buyback link?
Cambria, CII doesn't have any specific recommendations on that issue at this time.
Okay, thanks, Jeff.
All I would add is from a practitioner perspective, I would typically recommend that companies use 10b5-1 plans for stock buyback, again, for all the same reasons that you would with an insider to, deal with insider trading risks, MNPI, and of course it should be subject to the same conditions as a 10b5-1 plan adopted by an individual.
Thank you. And actually, Keir, you brought up a good point that I think, we focus so much on 10b5-1 plans for individuals, but companies can use them as well.
And actually, Cambria, I'm going to correct my statement because our newest policy does have language very similar to what Keir said. Either conduct the trades through such a plan or otherwise with some similar conditions around the trades.
Great, thank you. Thank you. Any other questions from the panelists? Maybe I have a few more. I think several of my questions were actually asked already. Keir, you mentioned a cancellation period of at least 6 months, which I thought was interesting because we were kind of talking about signaling versus, the extent to which that would have an impact. Can you talk about why it's that long?
Yes, and actually, let me just say with cancellations, the most common situation where I've gotten asked about cancellations in practice, not just in Uber, but just in life, is usually the situation where somebody sets up a plan and then some major corporate event, it could be layoffs, it could be who knows what it is, and they realize that there's going to be a trade pursuant to that plan the day before, and they're like, this is going to be horrible. People are going to think that I'm doing this intentionally to take advantage of whatever that event is, and it's typically to kind of avoid that perception. Just as an aside, in terms of why we were just trying to do something that we thought would be very, very clear to discourage people making cancellations, because again, we read the tea leaves, right? You don't want to encourage people to make frequent cancellations or modifications, and so that's why we've done that, and we just picked a period that we thought was the best practice based on the benchmarking that we did at the time.
So if a cancellation is the same basically as a trade, more or less, you have a 30-day plus the 6 months. Why the difference?
Yeah, it's not the same as a trade though. Like a cancellation, it's not an actual trade, right? But I think that's actually really important because the key thing, we're protecting both sides, right? You don't want someone engaging in insider trading, but you also don't want that person on the other side of the trade who doesn't have the same information. So I think that's actually really, really important. But in terms of the question, again, we looked at the benchmarking. Not every company even had something on cancellation with a delay. But again, based on, I'd written an article years ago that was pretty similar came out with similar conclusions from Dan while still at the firm, and that was something we just thought was a best practice. The 30 days versus 6 months. Again, we did the benchmarking. We looked around what other people did, and we tried to pick something that was kind of reasonable, but in the middle of the fairway.
Dan, do you have any comments on that at all, or Jeff?
I would just add, the cancellation thing is interesting because one doesn't observe data on that, right? And so, one could say, theory point, academic point, it could be, but it might also not be, right? And we just don't have the data because when that employee cancels, that's not going out to the market to say, hey, there was going to be this trade and now there's not. Where that does manifest a bit in the data, remember where I showed the plot of, I'll use my, academic language of alpha, when I basically showed the alpha or the abnormal returns to those trades, there was that discontinuity after the earnings announcement. So it was only the trades before the earnings announcement that really got that bump or that abnormal return and loss avoidance. One reason for that is potentially because if you knew that the earnings announcement was going to go against you, you could cancel the trade, right? So around an information event, you're going to have more cancellations, before the event than after the event, right? And that would potentially give rise to, depending on how the cancellations are being used, that could potentially give rise to this discontinuity where you see the greater alpha for trades that execute before. But I'd like to have data on cancellations, so that we could sort of do some more hypothesis testing and bear things out. But just don't have it, unfortunately.
Hey, Cambria, can I throw one more thing out there? This is not about cancellations, just something for the IAC and for the commission to consider, which is that thinking about this disclosure point more broadly, obviously it's very difficult to see what all these plans look like. But I do think it's worth at least noting the wide variety in structure for these plans. You can have very simple plans that literally just say, sell 30% of everything that vests over the next 2 years, right? That's like the most simple. But you also have plans that say, based on the trailing 6-month VWAP, we want to sell 5% at this price point, 10%. It's very, very complicated. And the question I would ask from a disclosure perspective is that actually useful for investors? Or is, to Jeff's point and Dan's point, is it more useful to have something that's broader that says, these are the number of shares that are subject to a 10b5-1 plan? Or here are the number of insiders that have 10b5-1 plans. There's a wide range in terms of what kind of disclosure. And I think the most important thing, and from my perspective, is like, what is actually going to be useful, decision useful either for the commission from an enforcement perspective or for investors, and either evaluating are my interests aligned with executive officers, i.e. do they have all of their shares subject to a 10b5-1 plan, or are they trying to, like all of those things. And I think that as you all think about disclosure, I think that I would encourage that you think about what you're trying to get out of that disclosure, because it may lead to a very different kind of outcome from a rule perspective.
Okay, Brian, you have looks like the last word. So we have one.
Just on that very narrow point, I've speaking as a large institutional investor, we're pretty good with complexity and we like information. So I would welcome knowing the complexity of the plans as they stood versus some generalized, this is how many shares could be affected if every little condition is met. That's much less information for institutional investors, who again are generally the owners of these firms. It's nice to know how the corporate executives that work for us, are actually planning to sell their shares.
Great. Well, thank you, Brian. And I'd like to thank Jeff, Dan, and Keir for taking the time today and having this wonderful discussion. I will turn it back over to Chair Marietta Westberg for moving forward with the meeting.
Thank you, Cambria. And I also want to thank very much Dan, Jeff, and Keir. Really just culminating in a fabulous day of data-intensive information and really stimulating discussions. And thank you, Cambria, for all the work you've done to put this together. So that brings us almost to the end of our meeting. We do want to have subcommittee reports from our 3 subcommittees before we adjourn for the day. So perhaps we could start with Chen.
Great. Thank you, Jennifer. I just give you a quick brief update. I just wanted to say one thing, which is I find it very, very interesting how we went from talking about technology where we could get to fractions of shares on spreads to where we're still manually putting information on paper in other cases. So just a bit of a dislocation that probably needs to be sorted out. At any rate, the Investment as Purchaser Subcommittee met on May 17th. We discussed our priorities for the year, two of which we are really actively focused on, which are the technology advancements in our markets today and the gamification of trading. So that is one thing that is in our line of sights, as well as the topic of senior abuse in the markets. We do have Jamila working on with Elise on a recommendation for IRAs, as well as Sandy and Leslie are working with the Investors Owner Subcommittee on the SPAC issue, and perhaps working toward some sort of recommendation there as well. And our next meeting will be June 21st at 2 p.m. So with that, I will give it back to you, Jennifer.
Thank you, Chen. So why don't we move to Christopher for the update on the Investors Owner Subcommittee?
Thank you, Jennifer. We're keeping busy over at IAO. Top priority right now is going to be a potential set of recommendations coming out of this afternoon's excellent discussion regarding 10b5-1 plans. And as has been discussed before, we may get something out over the summer. We'll see how that shakes out. In terms of other topics that we are thinking about, obviously supporting Sandra to the extent we can on any SPAC recommendations that she's working on. That's been very actively pursued. And more broadly, we are thinking about and trying to collaborate with IAP, the Purchaser Subcommittee, on the sort of broad topic of technological impacts, technology changes and their impact on the market, and various access, bias, fairness, disclosure issues that flow from that, ranging from both ends of the age spectrum, from protecting our seniors to making sure that we protect the newest, youngest entrants into the market. Number of different dimensions on that, and we're frankly still fairly early in that process. Gamification may be an issue. A little bit farther down the road, we're thinking about the accredited investor definition, and ransomware has been a topic that started to come up and may make it onto our list. And we've also been talking a little bit about SEC readiness for cryptocurrencies, potential digital fiat currencies, blockchain related issues, ICOs and NFTs and so forth. So lots of really interesting stuff, and technology is kind of an important theme in a lot of it. Thank you very much for the opportunity to give an update.
Thank you, Christopher. JW, I think we're back to you for an update on the Market Structure Subcommittee.
Are you sure you haven't heard enough from me today?
I was going to say, you've been on screen a lot today, but we're going to give you close to the last word here.
Okay, so for the Market Structure Subcommittee, with this is Mina's last meeting, it's just Paul and me, which is great. I love catching up with Paul, but I hope to recruit. If you all want to join for the meetings, just even if you don't want to make a commitment to the committee, you can just dial in and chat with us. I think that'd be terrific. I think one thing we'll have to talk about after today's best execution panels will be whether or not we want to do some sort of recommendation or not. I don't know what folks feel like on the committee, but I know probably one theme that came up was that there's strong disagreement about, is disclosure going to address some of the issues described, or is disclosure insufficient? So I think we gotta chat about that and discuss that. Other than that, one issue that we've talked about at the executive committee, I'll just mention that it's not necessarily only market structure. It relates to some of the competition issues we've talked about, but I think it spans across all three subcommittees, is an idea for a panel in September about auditing regulation. which is timely. You know, if you've seen the PCAOB is in the news the last couple of weeks there, so they will be hungry for new ideas and new thinking, I think, as the chairman, replaces the leadership at the PCAOB. So we are hopeful to I think, be helpful to that discussion and have batted around the idea of a panel with a debate between folks from the United Kingdom who've done a number of studies about the future of auditing regulation, and folks here, academics, and practicing auditors, who could all have join in that discussion about some of those ideas and the issues involving technology and the role of digital ledger technology and internal controls and all of that. Would be a good idea. So that's another idea to talk about. And that's all I have for now.
Thanks, JW. So I think that brings us to a close for today. I want to, as I'm sure all committee members do, give a fond farewell and an enormous thank you to Mina Nguyen and Allison Bennington for just their incredible contributions over the last few years. We will miss you very much. And then I want to give a thank you to JW and Cambria again for just the very stimulating conversation throughout the day on all of these topics. I want to thank Adam Anasich, who provides us just incredible support, not just in advance of these meetings, but also all throughout the quarter in a variety of things that we need to do to get our work accomplished. So thank you, Adam, and thank you to all the other commission staff who have assisted. And thank you to the chair and the commissioners for their thoughts today as well. We are adjourning for today, but we look forward to meeting again at our next public meeting in September. Thank you very much, everybody, and have a good evening.
Goodbye, everyone.
Thank you.